has a different pricing, different problems with the brokers or services. No, you come to Naga, you're an influencer, you set up your profile, you forget the business page on Instagram or Facebook, you lead everyone to us, they sign up via your link, they copy you automatically, same pricing, same service, one communication platform. And this is also what we believe in, because content is only good if the creator is happy and is being paid for. And this is one of our core, why our copy model is so successful. If you visit Naga, there's one very distinct screen. It's called the leaderboard. Every day and every month and every week, people are being ranked by performance, and you can copy them with one tap. Again, convenience. Convenience for being rewarded, convenience to consume content. And underlying core as well. Does this work? Oh, sorry. So it's the one KYC approach. So if we talk about brokerage, payments, crypto, later will be savings, later will be wealth management. What is super important is a shared wallet and account. If you use Amazon, for example, you can watch video, you can buy a ticket, you can buy your groceries. You never switch the platform, right? You just switch the categories. This is the same way that we are building. We have one shared wallet, one account, one user entity, and now we go into digital assets. We will launch our NFT marketplace. You will have the payments. You have the payments all around the globe. You have trading, you have investing. One wallet, one account, one app. People don't want to do 5 times passport uploads, 5 times POR, proof of residence verification. They don't want this. They want one app, one entity, they're happy. And this is what we will do as well, what we're already practicing. So with Naga, have one account for all services. Our customers are the customers of the future. Naga is a very young platform as well. So you will find a lot of young digital natives and millennials. This is the target group that we are having. Why? They're very active. They love social media. They're used to snappy, motion-driven interface. And these guys are the customers of tomorrow. And if we miss that train to make them happy, we don't have any business. It might happen that a social media platform will take over the entire financial industry. They could. They have the user base. They just didn't think there yet. But if Facebook decides, or Instagram, to launch a trading platform, what will we do? That's it. So you have to be there. You have to innovate vertically. That's what we're doing as well with Naga. And again, what's super important as well, we are a global platform. So you can sign up from all countries. We're going into licensing, of course. It's very, very important to be powerful as a platform on a global scale, because you don't want only a community in Germany. You don't want a community only in Italy or Thailand.
According to myself, I know I don't like this, I don't want this, I cannot do this, or I cannot do this, I like this, and I will force this.
And see a
I know what to do. So what I have planned,
again, like Instagram, you can
plan
consume content
is
from influencers
consisting
all
of
around the world. You don't
a number
really
of things
care.
we are going to
You have a
talk just
translation
briefly
feature,
about this.
you have good content, and you don't really care if the picture is from Brazil.
Whatever is wrong is that plan, change it.
Community and investing.
Do not touch the goal. Your goal is successful trade.
One KYC.
Your goal is to make profit.
Map,
so do not change it. You just change the way how you are going to reach that goal.
If you look at it,
maybe I can reach the door
that I want to
just going straight, or maybe I will go
not usually
to the right,
very
a
long
bit to the left, but then I will come out without any problem.
But I will tell you now that investors will only adapt to financial apps that are really bridging the gap between content creation,
your goal,
community, and global access, and allow you to trade any assets in the world, in the platform, without you being in the need to switch the platform to do another KYC, etc. You have one platform, and everything in the content world, and you will see it with our app if you check it out. We have a very nice booth. We're also doing a nice giveaway today because we're a sponsor of Sevilla FC, which are doing very well. You can win some tickets and t-shirts, but you will see that we really are a content providing platform with trading capabilities. And this is what Naga is all about. And with this, in a way, I wanted not only to talk about our product, because it's boring, but I want to give you something today to think about, that content, social media, and finance is the future when it comes to the clients of tomorrow. They will have money, but they expect you to be at TikTok and Instagram usability levels. And I think that 99% of this industry are 10 years ago and 10 years back. Thank you very much.
Thank you so much to Benjamin Bilski from Naga, giving that wonderfully informative talk. Yeah, we all need to learn about TikTok and Instagram a little bit more. We're just hopping out to source our next speaker. We should have them on stage in just a couple of minutes' time. So don't go anywhere, just bear with us, and we'll get our next speaker up very, very shortly. Thank you for bearing with us for just a few minutes, ladies and gentlemen. And as we continue our sessions at the Forex Expo Dubai 2021, I'd like to welcome up Mohammed Hashad. He's from Noor Capital, and his talk is going to be on the technical analysis of financial markets Q4 for this year. So please welcome onto the stage, Mohammed. Oh, come on, guys, help me out here. Yes, there we go. Thank you. just have a sound
Thank you.
check?
Thanks a lot.
Excuse me? Yes, okay. Ladies and gentlemen, with pleasure to meet you at Dubai Forex Expo 2021. Let me first introduce myself. My name is Mohammed Hashad, Head of Research and Development at Noor Capital, a member of American Association of Professional Technical Analysts, CISI certified candidate according to United Arab Emirates regulation and law. Today, I will discuss about the best trading opportunity in the last Q in 2021. Let's talk first about the euro against USD. Euro and USD are the most widely traded currency pairing across the FX world. Economies are the two largest, Eurozone and the States. The euro, along the USD, is also major global currency. The pair accounts for 28% of total transaction volume in FX market. I believe euro will go down during the last Q in 2021. I have some factors and elements regarding euro fundamental outlook. Euro is probably heading south for many reasons. Fed's tapering is expected to outpace ECB reduction of asset purchase facility, which is playing a favor of US dollar. ECB has started reduction of emergency asset purchase facility. Christine Lagarde insists that the lady is not tapering, which negatively weighs the single currency. Ultra inflation now in Eurozone, its high inflation rate, it's more than 3.5%. Ultra inflation is also harming euro and asset purchase facility. It's purchasing parity toward erosion. Negative development, including Evergrande new crisis, the China provider, real estate provider. Negative development, including Evergrande debit crisis and Delta strain, as well as any other development of same kind that badly affect the currency, and it's one of the most important risky assets in the market. Deterioration of service PMI, retail sales, and economic confidence is another reason paving the way down against the euro. Here, the technical outlook for time frame 4 hours. I'm using to use time frame 4 hours. The euro fell again during the last day session against the US dollar, as we can see a lot of negative pressure against the UNC index, stabilized below the broken support level, switched to resistance 1780, and generally stabilized below 11880. It's presented on Fibonacci retracement percentage 6180. I believe euro within the next couple of days, sorry. Yes, I believe the next couple of days euro will goes down against the US dollar. Therefore, I think the short-term realized will continue with the beginning of case in the market service likely to see noisy behavior in this case, but more or less or continuing grind lower. My target for euro by end of this year, it will be 113, which means like 400 points against the US dollar from the current market price. The pound. I put a headline for pound. Pound could be a winner, but not sure. But pound is better than euro. Performance for Great British pound is better than euro during the last months. Pound could be a winner. Pandemic relativity slows down with notable increase and very fast pace of vaccination in UK, which gives advantage to the Great British pound against the main basket of currency. Ultra high inflation also is pushing Bank of England's toward rate hike. I believe rate will be hike. Central bank inflation forecast reinforce the case of rate hike after the PMC said inflation could reach 4% in April 2022. That's why I believe pound may be or could be the winner. Bank of England Council are growing in decline to end the asset purchase program by end of 2021. Let's take a look about the technical aspects for pound. The British pound has rallied again during trading session yesterday, especially on yesterday's session, to show some sign of life. But as you can see, the level of 37 is still a valid resistance. I believe it can make some negative pressure on pound. But yesterday, pound break below the prime support or major support 1.36. That's why I believe today we can take from Great British pound or pound USD like 400 pips down. I think pound today or tomorrow by maximum will goes down like 400 points until 31 and 30. Gold. Gold is the safe haven for trading, as all of you know. Gold is all about tapering. I think moves of gold and most of precious metals next 3 months depends on tapering. Tapering talk of FOMC, which adopt hawkish language, which means I believe gold that will goes down within the next few months. Rising US bonds yield because of the risk appetite already improvement. Positive coronavirus development in both of infection levels decrease and return to the normal life. Dot plot forecast showed at the 9 of total 18 of FOMC members, they agree the interest rate to increase the interest rate in June 2022 versus than the previous vote, which indicate a hike should be in 2023. That's why I believe gold that will goes down. Let's talk about technical analysis for gold. As we can see on technical analysis chart 4 time frame, big bear flag pattern is in a place, show the chart. Medium term momentum has turned negative as MACD moving average divergence index generated crossover signals. Moreover, a negative pressure comes from sample moving average. That's why I think gold will go down below 107. Within next 2 months by maximum, we can find gold price goes down until 1,500. Crude oil. I think crude oil, it was the most winner financial installment like during the last months, starting by end of August because of Storm Ada and Nicholas. Larger than expected increase in the global demand for oil. About 30% of production facility in Mexico Gulf region are still not functioning because of hurricanes and storms, especially Ada and Nicholas. Faster than expected demand recovery from the stock of Delta strain of the pandemic. OPEC Plus also output policy next month in October. This keeping gradual increase of production is one of the main reasons for the current uptrend of oil prices, which is expected to continue at least until the end of this year. Maybe crude oil may be hit 80 US dollar for each barrel. Travel and tourism reopen globally. The demand of energy continued to be a main driver of the energy market. The 50 days moving average under that offered support previously. Let's talk about technical outlook. Technically, oil will, I think oil building a support floor located around 37.30, which combined with the positive motivation of sample moving average that support the idea of continuation of rising. In addition of clear positive sign on relative strength index is still stabilized above 50%. Therefore, we will maintain our positive expectation, targeting the first targeting 78, then 80. At the first target, taking into consideration the trading above the mentioned level at catalysts that continue off to visit 80 US dollar for barrel. In general, we continue suggest to overall bullish trend as long as trading is stable above 37.30 level support. This is my opinion, one of the most gain stock in 2021 is Red Cat Holding Company. sector, technology, service, industry, data processing service. This current price now is 3.60 US dollar. I believe this stock, it will move higher until 8 US dollar, which means we can make a profit next few days in this stock Red Cat holding company, like more for 5 US dollar. Nice to meet you and thank you. Thank you. You can visit us at booth 46, guys. I forgot. Thank you.
Thank you so much, Mohammed Hashad from Noor Capital, talking there on the technical analysis in financial markets for the rest of the year. And look at that, we've actually got through this morning's sessions a little bit ahead of time. So we're going to take a short lunch break for now. And when we come back, if we can all come back here probably about 20 to 2, that would be great. So 1:40, we will have a panel session, which is going to be on the latest expectations of traders in the Middle East and Africa region. So we'll start back here again at about 1:40. Thank you so much. Lovely to see you all here today. And I hope you're having a lovely time and finding all the information very interesting indeed. We'll see you back here in about 40 minutes time. Thank you. Good afternoon, ladies and gentlemen. Welcome back to Forex Expo Dubai 2021. We're going to be getting our panel session underway in Hall 1 in about 5 minutes' time. Our panel session will be getting underway in Hall 1 in about 5 minutes' time. So if you'd like to pop along and join us, we will be happy to have you. Thank you so much. So good afternoon, ladies and gentlemen, and welcome back to the Forex Expo Dubai 2021. Up next, we have a panel discussion for you, and it's the latest expectations of traders across the MENA region. And up on stage, we have Anand Shankaran, Head of Sales UAE Desk at NCM, Irfan Qureshi, Head of MENA Exclusive Capital, Abbas Karim Saddam, CFO at TNFX, and Talal Al-Samari, founder of Arabic Trader. And we're going to get stuck into this very shortly. And once again, I will be your moderator for this session. So, good afternoon, gentlemen. Thank you so much for joining us here today. It's an absolute pleasure to have you. If I could just go down the line and if you could just give a short introduction to yourselves and what your companies do, that would be wonderful. So, Anand, if I can just start with you, please.
Yeah, hi. Good afternoon, everyone. We are NCM Investment. It's a regulated company from Kuwait. It's a part of Showa Capital. It's a publicly listed company in UAE. We are offering different products, all the diversification products we are offering, like Forex, commodities, indices, futures, and CFD stocks also. And we have a local bank funding.
And Irfan? It should be on.
Exclusive Capital is basically, it's a European broker. It's a multi-asset broker. We are offering liquidity. The company has a lineage of 30 years in this market. And our focus is offering the best multi-asset products to our clients. We are regulated by SISIC. We are regulated by DFSA as well.
And Abbas?
I'm Abbas, the CFO of TNFX. It's located and regulated from Iraq. We are running since 3 years ago. We are offering FX, cryptos, metals, and almost covering all the financial assets. Our clients, the majority from Iraq and from the Middle East.
And Talal?
Yes, hi. My name is Talal Al-Sumairi. I am the founder of Arabic Trader. Actually, what we do, we offer added value services to the retail customers, like we cover the news, the market news, we do the technical and fundamental analysis, we do webinars, we do some educationals for the retail. And also at the same time, we help the brokers to approach their targeted segments as well. So that's mainly what we do.
You're the person stuck in the middle of everything, basically.
Yes, yeah, compromisation, you know?
So my first question to all of you is kind of, I hate to kind of say post-pandemic because we are still in it, but new trading styles have come up amongst traders. What are the recent expectations on asset classes from a broker point of view, and how are brokers catering to that? Anand, if I can come to you first.
Yeah, sure. Actually, after the pandemic, most of the traders and clients, they are interested in more diversification in asset classes. See, before all, they are sticking in one asset classes, either in gold or Forex. But now they are expecting a single window access for the entire asset classes, which it's easy to access for them in one platform. That is the main expectation from them currently they are looking for. And other than that one, they are expecting more easy and user-friendly platforms.
Irfan?
I think 2020 was very exciting year for the people who were trading. Though we were in pandemic, but still there were certain asset classes which they really outperformed. Be it US market, European markets, there was a huge shift in dollar going down against euro, gold went high, and above everything else, the cryptocurrencies, they have taken all the eyes on them. And the way they have performed it and the way people have managed to get profits from there, I think most of the traders are now really interested in cryptos, in the asset classes where they can make more money. They are taking more risks. And I think this is the main thing people are looking at, cryptos, CFD cryptos. So in my opinion, they have overperformed it and they are still doing it. People are still eyeing that Bitcoin might touch 100,000. So people are more of course, it's a risk business, but people are now more into the profits, which they can generate 5-10% a day sometime. So my vote is for cryptos.
Abbas?
You know, COVID has changed the shape, almost changed the shape of the whole economy and the financial system. So assets goes up, another assets goes down. And in addition, the fundamental data was totally changed. We faced a historical record of unemployment rate or the interest rate or the inflation. So as a result, a new opportunities was appeared to the traders. So now we see the majority of the traders, they tend to trade like stocks or cryptos in second degree, but mainly they focus on stocks because they have two features. One is they are more stable compared to the FX or gold itself. And the second thing, there's opportunities on shares or stocks because it will be influenced directly by the data of the economy. So when at the beginning of COVID-19, all the indicators go up of the economy. Now the economy started to recover. So a new opportunities has just come up. That's why most of the traders tend to trade shares.
And Talal, from your perspective, what are you kind of seeing from an analysis point of view?
Yes, let's agree first that after the pandemic, the financial market got a positive impact, okay? So if you look at the financial statements of the brokers, you will see they are making a lot of money because of the volatility on the market, okay? What we notice on our website, because we have a huge community, we have over than 80,000 members. We see that many of these members were asking for different asset classes. For example, they were questioning about the stock market, okay? Before the pandemic, most of the traders, they used to trade Forex, okay? After the pandemic or during the pandemic, a lot of them sees the increase on the US equities, so they want to ride this wave and get the best out of it. Okay. Also, we see a huge demand on the crypto, like Bitcoin, Ethereum, etc. Okay. So these two asset classes specifically are getting more market share or more interest from the users more than before. That's mainly what we notice on our website. Yes.
Yeah, I see a lot of crypto coming up in this market. I think we've now got developers accepting Dogecoin as down payments. It's crazy. I never saw that one coming, that's for sure. So regionally, the Middle East and Africa is one of the most prominent areas with a huge number of traders. So how would you prioritize the expectation of traders and things like regulation, which is always a concern, easy funding, spread support, and so on? And if I can come to you first.
Yeah, actually, now after this pandemic, I can address one more thing. Clients are they want more secure their funds. Okay, they are now more interested into looking into the regulations. Which company, where they are regulated? They are regulated in mainland or offshore. These things are started now in much than the previous years. Because the end of the day, the fund should be segregated in their special account. So then only they can be there. But very few brokers like NCM, we are offering a segregated accounts with them. And then we are covering 4 regulations, especially in Kuwait CMA, as well as Jordan JSC, Turkey CMB, as well as UAE SCA. All the places we are covering, and we are the broker which are regulated in the mainland. These are all the most expectations recently clients are looking for.
And Irfan, what are you saying?
No, I'm fully agreed with the gentleman. I think regulation is the most important thing, typically in this region. It's not very convenient and easy for us to deal the expectation of the clients, but over here, typically in Middle East, it's the large flows of money come into trading. And for that, I think the biggest want I see in clients is if we are regulated or not, and how many regulations we are covering. And after that, I think, as we discussed earlier, the asset classes. They again look for asset classes. The traditional trading in gold and euro dollar is there, but I think they are looking more. So on the second priority for the clients is the asset classes. And then with the regulation, they still want the spreads as well. They still want the leverage as well. So if you talk about the expectation of the traders, it's too high, but I'll rank the security at the top.
And Abbas, what are you saying?
Let's say regulation, it's not the most important part now, because, you know, after every financial crisis, there will be a new limitations on the, or a new rule. So there is a dilemma that the traders are facing, whether they go to the strong license or for leverage. Leverage represent the blood of the trader. So usually most or all the very strong license, they put limitation on leverage. So if we talk about reality, all the companies right now, even they have very strong license or regulation, and the same time they have offshore or license that allow them to offer very high leverage. So the reality is not the regulation, but the stuff that the traders need, which is the leverage, most important thing for them. And of course, they look for swap-free accounts and such low spreads, these things that the traders look for them.
And Talal, when you're dealing with kind of the end users, as it were, what are you seeing as their expectations, and are there any concerns?
Okay. Let me divide it between two things, okay? I think regulation is a must, okay? So the first question, when you offer a company to one of the retail traders, they would ask you one question at the beginning: where is this company is regulated? So it's a must. But maybe after they trade with this company later on, they will forget about the regulation and focus on the other, features or advantage, like the spread, like the easy funding style, like let's say if they provided, especially here in the region, the swap-free accounts, etc. Okay. And if you want really to approach more customers, you need also to add other features, like providing educational content, analysis, some premium services, etc. That's how they look at it. Once they trust you, okay, they will forget about the regulation, okay? And also there is a must thing you need to add, which is the customer service. If you are engaged with your customers, then they will like you more, and they will trade with you more. And then also they will tell others that to trade with you. That's the main point.
I like your point about the educational side of things. I don't think I've seen a time where I've seen more people wanting to get into trading than ever before, particularly into crypto, and the platforms and the brokers and the traders that are doing it well are the kind of the ones that are offering a kind of baby steps A to Z of how to get into it, and it's making it so much easier for people, and I think that's a fantastic thing. So what is the one best thing that traders across the region would expect to have from their broker in your perspective, Anand?
Yes, if you want to say, most of the traders especially in GCC and MENA region, they are expecting the swap-free accounts. They are treating as a Islamic account, so they are expecting this one. And second part, they want the 24 hours access of customer service. These are all the things majorly they are expecting.
And Irfan?
I think the list is very long. They want everything for free for sure. But what I see most of the time is the diversity. And again, we come back to the same point. They really want to be sure about the money they are investing with us. So the regulation and the diversity of the asset classes, my friend rightly mentioned, it's very difficult to offer huge leverage, which every trader wants. For them, 1:200 is like nothing. And at the same time, they want the security of their funds as well. They want the regulation as well. So there is a little challenge, but still they want it less spreads, huge leverage and regulation. So it's a huge list.
Leverage, security and regulate. I mean, security has got to be up there as top as one thing as well.
For me, yes, the regulation and the security should be, and it is on the top. If you deal with high net worth individual, this is their prime demand. They really want to know how the company is being run. They really go through it. And we as exclusive, we have been ranked the best in institutional clients. So for us, I mean, we always deal with the sophisticated clients. And for those clients, these are the two main important things, the diversity of the products and the security.
I need to address one thing. If end of the day, if the security and regulation is not tight, the clients can't get back their withdrawals. So that is very prioritized one. They need to check this one properly before going.
And Abbas, what are your feelings on all of this?
You have to let your clients have a confidence on what you are doing, because now all the companies are similar. They offer the same leverage, same regulation, same spread, same type of accounts. So there are specific things that you have to offer for your clients, which is mainly the support, how you support your clients, how you maintain their requirement or their needs. And then you create the confidence. So as long as everything is similar in this market, the only one thing you can play on it is the support, how you support your clients. So this is the most important that we have to focus on.
Talal, is there anything else you want to add to the checklist and what you're seeing?
Well, I really agree with the gentleman here. But to focus more on the value-added services. Okay, everyone has good spread, everyone has a good execution, etc. So let's think out of the box. Let's focus on the value-added services, education. I see a lot of brokers now are providing the social trading. Some of the brokers now, they are going even far, designing their mobile app application to be like in a Robinhood style. So that's maybe they need to look at these things so they come up with something new.
Well, I'm going to stick with you on that point, because my next question literally is, what do you see are going to be the innovations in the future in these platforms and the way trading is going? What would you like to see?
Well, we learned from what is happening on the pandemic, okay, and the IPO of Robinhood, okay. So many users, they are trading with the Robinhood, okay. This is really amazing because of their trading platform, the mobile one, and also their style of the business model. So the commission-free style, So I think this is really needed. This is the new innovation, and the social trading. Let's also add the social trading part.
Abbas, what are you seeing as the innovations of the future?
Let's say mainly we need to spend more on education for traders, because we have two sides in order to get more traders to be involved in the market. Whether we want to educate them to be traders standalone by themselves, or we offer them the like social trading or money management services. So we should focus on both sides, but mainly on the education. Because at the end, you need an educated trader, even if you go to the other direction and he use the copy trade or the money management services. The education is the most important thing in these times, because this is the way how to gain clients and traders, and because it's you will continue when your traders are have a good knowledge and how and they make money when they trade.
Irfan?
Yes, I'm totally agree that the innovation is all about education. At this point of time, everybody want to make money, because I want to do crypto because my friend is doing cryptos and he made some money out of it. And the right way to get to the reach of most of the trader is to get them educated. The companies must need to invest in the technology where there is a flow of information. There are webinars, and there are there are certain programs which can be run through the clients, through the traders, where we educate them and how the market is reacting. We have to tell them certain serious things about the markets as well, that it has a certain reason to react. There is a news, there are technical analysis, and all those things are pretty important. And in the future, yes, everybody just want to make money and everybody is in a hurry. So the broker which will invest in the technology, which is getting the news faster, will definitely surface better than others.
Anand?
Yeah, I can address in this question as a two-part. One is education, another one is single window access. We can say how means if a client or a trader, they want to do all in one platform. Either they needs to trade, either they needs to check the economic updates, either they needs to check the technical analysis, as well as other things. So they are expecting from the broker single app which covers everything. Even they should place the withdrawal, they should place the deposits, whatever they want, they need to do. They don't want to, they are thinking they don't want to go jump into one app to another app, what's happening, it's updated or not updated. These things they are expecting mostly in innovation. And secondly, which broker is offering more educational materials as well as webinars, seminars, and expert advisories, some type of things they are looking for it. In this regard, I can address, we are already, last 4 years, we are having our own academy. It is called Noor CM Academy. We are conducted more than 500 webinars in couple of years, as well as we are having our own app. In the app, as a single window access, we are covering all these things. What I have described now, everything it is covered already.
I mean, there's no question that technology has a huge part to play. I mean, I have friends, they still sit there, you know, with 5 or 6 screens and they got their technical analysis and their stocks and their crypto and everything. And it's all crazy. And now we're having everything in the palm of our hand. But obviously with the rise of technology, there's also the risk of hackers and added security. So how far are we going to be able to push it technologically and still keep it secure? So let me ask you that question, Anand.
Yeah, in this regard only I am saying, see, these all the questions what you ask, already the regulators are putting in front of the broker these questions. Okay, if it go to the CMA in Kuwait regulation, they are keep on checking all these aspects in every monthly basis, not quarterly. Now they come into monthly basis. What technology they are using, how secured your funds, how you are keeping the client's money safe, all these things they are started. No need to, the clients can check because it's covered under the regulation. Regulator is doing all these things on behalf of clients. So we can do this one. No need to worry at all.
And Irfan, how far do you think we're going to see technology take us with this?
I think the last 2 decades is all about technology. Technology has changed the world. The risk is there and the risk will always be there. There is no doubt about it. But how we cover it, how much we invest in our technology, how much we invest in the platform, where we try to mitigate the risk. The risk only can be mitigated. There will always be a risk of hackers. There will always be a risk of problems. But it's only investing in the best of the best in your own platform, giving the confidence to the people. That's the only way out, I believe.
And Abbas?
Actually, this is a big challenge, especially the brokers facing it. And this question, actually not the brokers to be asked for, the technology provider, they have to pay more attention for it because they are the player in the market. And let's say in last 1 or 2 years, there is a very good investment in this regard. So it can be mitigated, but still a challenge. And we can see from time to time, there's technology providers, they get damaged, and as a result, the brokers. So it's still a challenge for everybody.
It's a work in progress, isn't it? We kind of learn as we go along and make everything as good as we can at the time and keep learning. Talal, from your point of view, where you see both sides, how far does adoptability go and the trade-off with concerns for technology? Are you seeing more people wanting to use technology based platforms, or what's your analytics telling you?
Well, I don't see a lot of risk from the retail side, okay? Because retail, they put their money on the broker and the risk should be handled by the brokers, you know? If you look back at the 4 or 5 years ago, okay, you will see a lot of risk is coming from the crypto, okay? Many exchanges were hacked, many exchange with $1 million, okay? But I think there is a good progress now. They are getting much educated, okay? So they have a plan to mitigate all these risks, okay? As my colleague said, the risk is still there. You cannot say there is no risk. It will still there, but you need to enhance your technology to mitigate all these risks. So yeah, it's a part of the game, you know? So you need to just consider it and have a plan for it.
Challenges, but with a good payoff at the end, we hope. Gentlemen, thank you so much for joining us today for this panel session. Please thank Anand, Irfan, Abbas, and Talal. Wonderfully informative and interesting session.
Thank
and
you.
thank you for
Thank you,
joining
everyone.
us.
Thank you so much for being here.
Thank you.
Thank you, gentlemen. And we will get our next speaker up here very, very shortly. So just bear with us for another couple of minutes. Thank you so much. And we will be hearing from Habib Akiki, Senior Market Strategist at XM, talking about key market trends and best trading opportunities. And we will get into that very, very shortly. Thank you for staying with us, ladies and gentlemen, here at Forex Expo Dubai 2021. And our next speaker is Habib Akiki, Senior Market Strategist at XM. And he's going to be talking to you about the key market trends and best trading opportunities.
Good afternoon, guys. Good afternoon and welcome. Crazy times we are living, yeah? Already 2 years have passed since the pandemic and we are still going on. Now, during this period, COVID crashed the financial markets. But in no time, and due to the unprecedented stimulus packages done by governments and central banks all around the world, this has sparked a huge recovery. Now, among the various asset classes, the most favorable go-to market was the equity markets, the stock markets. After dropping by around 35%, we over doubled in value during 1 year. Another market which is basically attracting a lot of participation from retail and institutional clients mainly is the bond market, the treasuries. And commodities, the recovery in the global markets, the supply chain disruptions, and also inflation has caused a huge rally in commodity prices. Nearly all commodities are back to pre-pandemic levels. Even most of them are at levels higher than they were before the pandemic. Also, investors are hypnotized by another market, the crypto market. Everyone wants to trade cryptos now. You know, this market, in less than 1 year, the value of all cryptocurrencies has moved up from 300 billion to 1.9 trillion. So with all the volatility going on in the market, which asset classes should we invest in? Should we go for the stock market? Shall we invest a little bit in bonds, buy commodities, cryptos? What shall we do? To better understand, I want to show you a little bit of historic data. If we look at the historical returns for the last 20 years, you notice that the REITs, you are familiar with REITs, real estate investment trusts, which are companies who finance and own income-producing real estate in different sectors. REITs, this is a REITs ETF, okay, Vanguard ETF. This ETF has produced over 10% on average over the last 20 years. Among the good asset classes is the equity market. You can see that the total stock market, the US total stock market, that is large cap, small cap, and medium caps, averaged 9.8% for the last 20 years. Of course, large caps as well are closely similar to it, with 9.2% average annual return over the 20 years. Gold is a good performer. Gold also generated over 9.5% yearly over the last 20 years. And then you can see the bond market with 4%, the commodity market 2.5%, and cash generating only 1.1% on average. So if you have cash in the bank, my advice to you is to better put it somewhere else. Choose anything else. Buy whatever you want. Just don't put it in the bank. They are not giving us any interest. Okay, so wherever you invest your money, you are better off. Now, if we take a look at the last performance, the yearly performance, notice that REITs this year went up 29%. Of course, there is no surprise that the stock market is doing really well as well. The general stock market is up 20% this year, 21% last year, and in 2019, 30%. Huge growth in the stock market. Now, what shall we look at? Gold. Gold this year is down 4.5%. But the year before, in 2020, it was up around 25%. And in 2019, around 18%. So huge volatility in the gold market. But overall, as we've seen before, for the past 20 years, gold is still stable around 9%. Commodities, this year, 30%. Huge rally in commodities. Of course, due to inflation and supply chain disruptions. But if you notice, there's a huge difference in the yearly return for commodities, while cash is always stable and the lowest. Now, to better understand where we should invest, we shouldn't look only at returns, but we should also take into account the drawdown or the volatility. Now, for that reason, I prepared this table here, showing you the 10 years compounded return for these asset classes. So when we talk about REITs, real estate investment trusts, for the last 10 years, they generated 181% return with a minimal drawdown of 25%. Of course, the best asset class here are the stocks, on compounded 350% for the last 10 years, with a drawdown that barely exceeds 20%. So does this answers your questions about where should you invest? I think there's the clear image here we can see. Notice gold. Although gold is a very good investment in all portfolios, notice the volatility and the drawdown in the last 10 years. 42% drawdown, 42% drawdown, and an average return, or sorry, not average, compounded return of minus 4.5%. Okay, but for the last 5 years, the return is much better, if you notice, 36%. So huge volatility in the gold market. Of course, commodity is the worst, in my opinion. For the last 10 years, 62% drawdown for a compounded return of minus 34%. That is not good. But the worst in all the studies we can perform here is cash. So don't hold cash if you don't want to use it. Invest it anywhere. So where shall we invest? Let's start with the REITs. Guys, are you familiar with REITs, Real Estate Investment Trust? At 14%, commercial real estate is the third largest asset class in the US investment market. Now, to participate in commercial real estate, you can simply go and buy a property and rent it out. It's a good investment. But if you want to skip all this hassle, all you have to do is buy REITs ETF. Now, REITs historically have delivered competitive total return based on high, steady dividend income and also moderate capital appreciation. So people who are looking for continuous income should invest in real estate trust funds. Now, why REITs give us a steady dividend income? Because simply they are required to distribute 90% of their taxable income to their investors annually. So they are a good investment for everyone who is saving for his retirement but also a good investment for people who already retired and they want an income basically to fund their daily expenses. REITs have delivered over 10% return for the last 20 years. And if we look back at the past 40 years, the average annual return exceeds 11.5%. Imagine that all you have to do is buy a REIT, buy a real estate investment trust, and you will be earning over 10% yearly. How much is your cash giving you in the bank? Or even speculation in the market, how much is it generating in profits? Question is, should we invest in REITs? My answer is definitely. Okay. One good competitive advantage is that REITs is not correlated by a big extent, to a large extent, with other asset classes, especially with the US and global stock indices. We have a relatively low correlation. So REITs are a very good diversifier that we can have in our portfolio. Now, when we talk about the stock market, what do you think? The stock market, of course, the pandemic hit, the market crashed 35%, but ever since March of 2020, the stock market bottomed and the recovery, the fast recovery started. This recovery, of course, was due to the unprecedented stimulus packages by central banks and governments. From March 2020, the S&P is up over 100%. To be precise, 101%. The Nasdaq is up 124%. Let those numbers sink in. The stock market value have doubled in less than a year, or in slightly over a year. Question is, shall we invest in stocks, or is it too late after all this rally? I think, in my humble opinion, we are still in the early stages of the bull run. So, and in my opinion, it's never too late to invest in the stock market. You can buy even when the market is printing new highs, is at its highest values ever. Don't be afraid to invest in stocks. Now, I believe we are still in the early stages of the bull run due to many factors. First, the equity market is enjoying an increased interest and participation, not only from institutional clients, but also what we've seen lately, increased interest from retail clients. Last year, it is estimated that the brokerage industry added 10 million new accounts. 10 million new accounts. Those accounts are all for retail clients. So all retail interest is pouring into this market. And it will continue to, because once you start investing and trading, you never stop. Now, stock holdings among Americans are at 41% of their total assets. 41% of the total assets are in stock holdings. This is the highest level on record ever. Another factor that contributed to this huge growth in the stock market is the cash at hand. The excess liquidity among investors. Guys, even before the pandemic, the cash at hand was at very high levels. And when the pandemic hit, when COVID hit the market, cash hoarding even grew more. And it was only reasonable for some of this cash to find its way to the stock market. Now, why the excess liquidity among investors? To understand that, we should basically differentiate between what happened in 2008, so the quantitative easing of 2008, and the quantitative easing of 2020. In 2008, after the crash, the Fed increased its balance sheet from 800 billion to 4.5 trillion. But this is over the course of several years. And this printed money, basically, the purpose of it was to recapitalize the banks and restore confidence in the economy. Actually, none of this printed money was injected in the real economy. Now, in 2019, the story is different. After COVID, the Fed started QE again, but this time printed in matter of weeks, $3 trillion. And this time, the money was given directly to consumers to spend. They were given to companies to retain the employees. And that is why we witnessed this unprecedented excess in liquidity. And this liquidity went to the market and is still finding its way to the stock market. Now, one more very important factor that will sustain this rally is the lack of an alternative investment. Now, if I ask you a question, where do you invest your money? You have $1 million. Okay, maybe not all of us, but don't think about retail clients. Think about hedge funds, mutual funds, big investment funds. Where do they invest their money? With interest rates non-existent and low treasury yields, where do they invest their money? They have no other alternative than the stock market. And I believe that as long as the 10 years treasury yield remains below 2% and the 30 years yield remain below 3.5%, investors will have no alternative investment but to invest in the stock market. And even if the Fed now is on its way to start tapering and hopefully increase interest rates, the rise in interest rates will not happen until few years down the road. So now the expected increase is 0.25% end of 2022. So we have still at least 1 year of low interest rates. And investors will always favor the stock market. Now I understand that with the inflated valuation and due to this unprecedented rally, we could be on the doors of witnessing a large market correction. This is totally understandable. Let's take a look at the chart to better understand what's going on. If we look at the chart, this is the chart of the S&P. This is here the low of March. This is the lowest point reached, March 2020, and this is the rally ever since. This is the monthly chart, so every candle is a month. Did you notice a thing here? Look at this rally. Look at the slope. This is not sustainable. Okay, for everyone who practice technical analysis, should know that a steep trend is not sustainable. So a correction could be on its way. Actually, it just started. We broke this uptrend. Now, in technical analysis, we believe that a decent correction should be between 1/3 to 2/3 of the directional move. So if we take this directional move from the low to the high, from March 2020 to the all-time high, let's consider a correction based on Fibonacci retracement levels. A 23.6% correction would be at 3,990. A 38.2 correction would be at 3,650. And a 61.8% correction would take us to 3,090 levels. Where will the market, how much will the market correct? We will never know. Guys, if the market corrects 61% of this big move didn't correct yet. No retracement for this move. So because it's a very steep move and because the drop will create panic and a lot of profit taking, I think the correction could be also deep. So if we reach a correction of 61.8%, that would be only 60% of the last move, but only 30% of the total value of the index, from 4,500 to 3,100. That's roughly around 30%. That is a very good correction if reached, if the market managed to correct this low. So my advice to you, where do you buy? I always get asked this question. When shall we buy? Well, buy in tranches. Don't buy with all your money at once. When the market reaches 4,000, buy some. If it kept going down, buy more at 38%, at 4,000, at 3,650. And if it reaches 3,100, buy with everything you have left. This is what you should do. Don't complicate things. Find an ETF, SPX, okay? It tracks the S&P 500. So you will be looking to the large cap US stock market and just buy it. Take part in this rally. The growth will continue for years and years to come. For the last 20 years, returns over 10%. What do you want more? Now, let's talk about crypto. Big fuss about crypto, yeah? Everyone wants to trade crypto. With no doubt, the growth on this market was basically due to the participation of the cypherpunks, developers, and tech freaks, unlike myself at all. I am not even close. But now, lately, even institutional investors are pouring their money in this market. So, should we invest in the crypto market? Guys, this market is attracting institutional investors like never before. The crypto market has grown at a rate unheard of in other financial assets, and is expected to keep growing based on many valuation estimates. Now, Bitcoin is becoming a safe haven. It is serving as an inflation hedge, and according to many analysts, Bitcoin could become the gold of the 21st century. So, institutional money, as we said, is pouring into the crypto market. Activity from institutional investors seems to be picking up. $17 billion of institutional funds entered the crypto world this year. What does this tell you? When funds and money managers like BlackRock pour their money in this asset, I think this asset is there to stay. Of course, volatility has always been the downfall of crypto. Volatility is in a different league when compared to other asset classes. But volatility is taking a turn. More institutional investors, more liquidity, Also, a derivatives market is being developed, and this will help reach a more sustainable market. So should you invest in crypto? Simply, yes, invest in crypto, but don't trade crypto. Invest, don't trade. There's a big difference. Buy and hold for the long term. Buy with 5 to 10% of your portfolio, not more. Now, when you want to buy crypto, buy with crypto exchanges. Don't buy with Forex and CFD brokers, because you want to buy and hold them for years. And buy well-established coins with strong fundamentals. Don't buy meme coins, you know what I mean. This is how you should invest in crypto. And last but not least, because time is up, I wanted to talk about gold. Now, with the Fed expected to start tapering, with interest rates on the verge of rising, many factors have to be taken into account when we talk about gold. But just to simplify things, investors will always buy gold, okay, to protect themselves from volatility and uncertainty. And even although it's a highly volatile commodity, it has proven that over the long run, gold will provide good returns, and it should be part of any portfolio. And for everyone who thinks gold is gonna crash like it did in 2013, I don't think so, because gold is, of course, inversely correlated with interest rates, but what affects gold more is real interest rates, which is interest rates minus inflation. And because inflation is expected to rise and keep rising in the coming years, real interest rates will always stay low, near zero, and this will give support for gold. Also, gold in 2008, 2013, 14, 15 crashed, not only because interest, actually, let me show you this. Look here, inverse correlation between, we are seeing real interest rates, not interest rates, real yields, and gold in yellow. We have perfect negative correlation here in the crash of 2013-14, and also perfect negative correlation in 2019, 2020. However, notice here what happened. This is real yields. They went up, gold crashed. Okay, notice here what happened. Real yields went down, but gold did not go up. Why? Because gold is also correlated to the dollar, and the dollar witnessed a huge rally during the period of 2014, 2015, due to the divergence in the monetary policies between the Fed and the ECB. The Fed was raising interest rates and the ECB was lowering interest rates. And this is why the dollar witnessed a huge rally. Look here. This is the rally of dollar in blue. And this is what prevented gold from going up as real yields went down. Now, do you expect gold to go up in the coming years? Yes. Do I expect Do I expect the dollar to go up in recent years? Yes. In the coming couple of years? Yes. At the same pace it went up in 2014 and 15? No, because now all the monetary policies are aligned. Okay, everyone will start tapering. All the central banks will start tapering. Okay, one faster than the other, one sooner than the other, but they are all aligned in their policies. Inflation is global, and they will need to raise interest rates. So I don't think the dollar will witness the same rally. So just to sum everything up, it is pretty simple, guys. If you have cash in the bank, take it away, buy ETFs, 10% gold, 5 to 10% in crypto, if you are young and you want to take part of this market, 30% in REITs, and 50% in stock ETFs. It is very, very, very simple. No need to complicate things. Now, if you want to trade, if investing is not fun for you, you want to trade, I can help you. We at Tradepedia, we train traders. We teach you how to trade and speculate properly in the market. We teach you technical analysis, we teach you fundamental analysis, we teach you money management, and we teach you discipline. And now we partnered up with XM brokers, and we are delivering live educational seminars every day. By being a client for XM, you can join these educational rooms every day, 7 hours every day of live education by myself and my fellow colleagues, the analysts from all around the world in multiple languages. If you want help, come to us. We'll help you. We'll give you technical indicators developed by our own team that will do the analysis process for you. So you will have more time to trade rather than spend hours analyzing the market. But we teach you how to do it properly. If you don't want to learn how to trade properly, don't burn your money. Invest. And if you want to trade, let us teach you how to do it properly. Or else you will lose. Education is key. And this is what XM and Tradepedia are doing. Okay, we have amazing tools, amazing indicators. You put them on the MT5 platforms, they give you the signals, where to buy, where to put the stop loss, where to take your profits. But we also teach you how these indicators work, so you know what you are doing. We teach you money management and risk management to know how much to risk on every trade. Thank you very much. It was a pleasure being among you in these times. If you have any question, I'll be at XM booth number 10, to answer all your questions. Thank you very much.
Thank you so much to Habib, Senior Market Strategist at XM. So we want diamond hands, not weak hands,
No,
right?
of course.
We
Yes.
want diamond hands.
Diamond hands.
Invest and hold. I'm learning slowly.
You should.
Thank you so much. Pleasure. What a fantastic insight there. And up next, we welcome our next two speakers who are going to be talking about where gold prices are going to be heading in the last quarter of 2021. And we will welcome up Mohammed Al Mariri, Head of Training and Market Strategy at Orbex, and Karina Kowalski, Head of Business Development, Polish Desk at Orbex. So please welcome them both up to the stage.
Hello.
Big green one to go forward. There you go. Yes, it's laser. It's for your presentation. On my presentation? Yeah. The laser point? That one doesn't. That one.
Thank you for attending this panel. We hope we will share our experience with you as well. Me and my colleague Karina, she's the head of Polish desk at Orbex. She's an expert on technical analysis and Fibonacci geometric on the chart reading, and she can introduce herself by herself.
Welcome. Well, ladies and gentlemen, welcome to our Orbex presentation. My name is Karina Kowalska. I am head of Polish desk at Orbex Broker. I have been in the trading industry since 2014, and I am also a Forex educator at the biggest trading school in Poland, Fibonacci Team School.
I'll start from where Habib ended. How important is to educate yourself if you're planning to trade at this market. There are two important things that you have to learn to start figuring out where to enter and where to get out of the market is the fundamental and technical analysis. Karina will start with the technical analysis for the gold on this quarter till the end of the year, and I'll take over on the fundamental part. You can start, Karina. I don't know how to use this actually. Oh, okay. So, how to go on this one? The green button. Just press the green button. Okay.
Ladies and gentlemen, today in my trading presentation, I would like to explain to you what is Fibonacci geometry and why it's so important in technical analysis in trading. Let's start from its origin just in 2 sentences. The geometry of the market was founded by an Italian mathematician, Leonardo Fibonacci, who lived at the turn of the 12th and the 13th century. What is the most important? Thanks to him, European mathematics, after many years of being dormant, began to live again. And his main discovery, which is the sequence of numbers, today we call the Fibonacci sequence. Now let's explain what the meaning of the market geometry. And the market geometry is mainly based on comparing the segments that create the highs and lows of prices. For example, we use time and price analysis, but the use of the market geometry allows us to study dependencies in both an upward and downward trend. But we always must remember that we only analyze the height of the sections, but not their slopes. Yes. Why? How to go back?
I think there's something wrong with the presentation because the chart is not showing on the screen. We have to check with the organizers.
Yeah, I'm not gonna talk.
Thank you for your patience. We have to postpone the presentation for another 30 minutes until we send the presentation because there's a problem with the charts and we cannot explain without the charts. So it will be postponed. Thank you.
Hello, hello. Ladies and gentlemen, apologies for that. We'll sort our technical difficulties out very shortly, and we'll see if we can bring in one of our other speakers a little earlier. But just do bear with us a few minutes, and we will sort ourselves up and come back to you shortly. So do bear with us. But thank you very much for joining us today. What's going on here? You want a picture?
I'm taking $10 just for the fundraiser. For your friend? Perfect. No, thank you.
Hilarious. That's never happened before, that is for sure. Apologies, we will sort out our former speaker's presentation as quickly as possible, but thank you so much to Wael Makarem for jumping in a little bit earlier. He's from Exness, and he's going to be talking to us about where could the US stock market be heading in Q4 of 2021. So welcome to the stage, Wael.
Thank you so much. Is it, it's working. Hello, everyone. Thank you all for joining here. I hope everyone is well. So I decided to talk about the US stock market going into the fourth quarter. As we all know, September is a bad month for stocks historically. And we witnessed during the past couple of weeks the downfall that we saw. We were trading at record for S&P, Dow Jones, and NASDAQ. And now we're almost 5% down off the tops. So first, we're going to start with showing the past performance for US indices, especially the S&P 500. I'm going to dissect the returns on yearly basis and on weekly basis since 1927 till today. And then we're going to go over some sectors to check which sectors are overstretched, which are undervalued, which could have some opportunities. What are the good industries to invest on the medium to long term? And then we're going to highlight some of the bullish and bearish factors for the market going into the fourth quarter. And we're going to finalize with a technical analysis on the S&P 500. So first, this is yesterday morning before the drop that we had yesterday during the day, around 1.5%. So up to year to date, the S&P is now almost 18% up on the year. NASDAQ is around 16% and the Dow Jones around 13%. So we're down almost 1% from these levels that were highlighted yesterday in the morning. You can see a clear uptrend. We had some corrections earlier in March, especially for NASDAQ. This, we're gonna talk about this in a while. What was the reason for this drop? And then we were able to recover, and then the market went to new highs. And when we started September, the market corrected a little bit. So what's behind this rally? What caused this rally? Thanks to the Federal Reserve and the ultra loose monetary policy, a lot of asset purchases. Thanks also to Trump previously and now Biden, all their spending plans, the CARES Act, a lot of money was pumped to the markets, to the economy, and this was translated with good returns to the market. So this is the S&P 500 since 1927. We can see the crash back then and then how it was trending upward. Despite all these moves down, we had 3 secular trends and now we're still trading at record high. So all these dips that took place at the time where the market was recovering and investors were able to see higher highs for stock indices, and this is especially S&P 500. Excuse me? Someone was asking something? Okay, so these in gray here, they are the recessions that took place. So since COVID, we were in a recession, but the stock market is performing positively. And as I repeat again, this is due to ultra loose monetary and fiscal policy from central banks and from governments. We are on the verge of a change in monetary policy. We're going to be talking about this in a few also. So this is the annual return for the S&P 500 since 1927 until the present. So I decided to highlight this 20% benchmark. There's a lot of people they were mentioning during this year when the S&P 500 reached almost 20% in performance, they started saying that the market is overstretched, overvalued. We're gonna look for corrections. But if you look historically, since 1927 till today, almost 30% of the time, the S&P succeeded to pass 20% or above in returns. So if we during the fourth quarter, we were able to recover and then the market end up the year above 20%, this is also somehow normal for the S&P based on these returns that we are seeing. If we want to go more closer into this is a nice chart. This is from 1927 till today. These are the weeks, 52 weeks of the year. And this is the average performance of each week from 1927 until today. So you can see here, we're currently, if we're using the European calculation for the year, we're now in week 39. Usually week 39 is the worst for the year with an average drop of 0.7%. And now we started the week on Monday. We had a calm session. On Tuesday, the market dropped. Today, we're recovering a little bit, but on the week, we're still down. So if we're using past performance in order to highlight what's happening in the market or to predict what could happen, we can notice that in September and October, we had 3 weeks down in September, 3 weeks in October, which suggests that if we lose some momentum going into the fourth quarter, we could be facing a slight drop in October, and then we could be heading into new gains going into the end of the fourth quarter, and then this could continue going into the new year. So now here we will have, at the end of the year, we have something called Santa Claus rally. It's the holiday season rally where stocks usually outperform. We have on average a return of 0.4% during the last week of the year. And then this continues during the first, the second, and the third weeks of the year. So if we're just gonna base our assessment on this past performance, weekly returns from 1927 until today, we can notice also the seasonality. So here, and this is in mid of May, it's week 20. Also this year, we had a drop in the same week. So, so this year, almost these seasonals, they were doing well. They were matching with the past performance. Now let's dive into the sectors of the S&P 500. If we just have a clear look on the top performing sectors, first we have the energy sector, the S&P, which is up 35.1% for the year. It's amazing. It's benefiting a lot from the reopening of the economy around the world, and especially with higher oil and energy prices. The companies, they're a little bit tight on spending. They're not going into more production investments like they've done in 2014. So they're trying to just make sure the market is settling near these prices, and they're trying to secure their profit margins. That's why these companies, they are more, they're outperforming rivals. And this is why we're having an outstanding performance for the energy sector this year. Financials, they're also benefiting. Last year, we had a little bit of spending. Most of the economic activity around the world was shut. So people were saving money, and banks, they did benefit from those savings. They invested these savings. They had some returns. Also top banks, they did benefit from the volatility that we had in the markets last year. And this was translated into more returns for their investment departments. And thus we had outperforming sector. Also, we have now a promising higher yields, where also these banks will be relying on higher returns from US Treasury. So this will add their profit margins. So that's why some people are more bullish now on financials than previously. The real estate sector, we know that many investors prefer real estate in order to hedge for inflation. And also, if we have to look on the other side, we had ultra low mortgage rates in the United States. So this supported or fueled the demand for real estate along. So it's very easy for me now to have a loan, to have a mortgage, so I can go and buy a house. If I have certain amount of that I can afford to buy a house, and I want to make sure that inflation doesn't erode my savings, I could go and invest in a house. And this is what happened in the United States. We've seen REITs trading at record highs. We've seen a housing market in the United States that's booming. Prices, they're up almost 15–20% in different places. So this is why we had a very good real estate sector this year. Communication services and IT. So this is also, it goes back to working remotely and using a lot of services of these companies that supported us during the pandemic and made us more into connecting with each other using their platforms. So definitely we're invested in this sector, and we've seen also outstanding returns. This is the S&P 500 generic. So these sectors, they outperformed the general S&P 500, while these sectors, the healthcare had an outstanding performance during the beginning of the year, but then going into a better shape with COVID, some investors favored having some profit after having a decent rally in the healthcare sector. So this is just why the healthcare is not as outperforming as others. Industrials, consumer discretionary materials, staples, and utilities were performing under the general S&P 500 returns. Okay, so this is here if we just want to also have a closer look on sectors. In red, it's the 200-day simple moving average. So by looking at these technicals, we can see which sectors are almost overpriced or overstretched relative to the S&P, to the simple moving average, the 200, which gives us a good signal whether we're just going far away with the direction. So you can see the S&P since May 2020, the S&P failed to close below the 200-day simple moving average. And this is the 5th record rally since 1993 for the S&P staying above the 200-day simple moving average. Many investors are just now expecting the S&P to retrace a little. We'll go over this in the technical analysis session to show you where does the 200 simple day moving average stand at the moment. This is the healthcare sector. So as I said, we have some profit taking at the top. We're seeing a bit of reversion to the mean. The communication service, it's still outstanding, very far from the moving average. This means that some investors could go into more profit taking going into the end of the year, and we could be facing a little bit of a correction. Industrials are already down. We had a double top in industrials, and then we moved back towards the 200 simple moving average. This is consumer discretionary. Also now we're still in times where investors or citizens, they're not fine enough now still with the fact to spend more money on discretionary. So we're not into a full expansionary phase now. So that's why these companies, they're still, if you can look at the performance of the sector along with the 200 simple moving average, you can see how it's very close to it relative to others. Also the IT and information technology, it's at record high, also far away from the 200 simple. Consumer staples, they're closing in since investors favored going into more aggressive sectors than those defensive sectors that had outstanding performance during 2020. So this is why we had in 2020 a bit of an overextension in this sector, and then we had corrections and reversions to the mean as the rotation took place with investors favoring more aggressive sectors than those defensive sectors. The materials are also there. They had a lot of movement lower since if we noticed during July and August, we have a bit of a drop of some of the major commodities, and this just translated into weaker materials sector during that period. If you just notice the difference between all these that we just showed, you can see clear uptrend in most of the sectors. However, if we look at energy, they suffered since 2006. They had a top here, and when the market collapsed in 2008, in 2008, almost prices were around 150 for a barrel, and then we didn't come any closer to these levels back then. So now with this drop, energy sector suffered well when prices went into negative during 2020 and then started to recover. If we just compare this to energy prices, it's almost copying the price of crude. So with now more expectations of oil prices going into $90, there could be some room for energy companies to increase their profit margins going into the year end, which gives us good opportunity to invest in energy sector going to the year end. We're going to talk about renewable energies, but still at the time being, energy sector looks promising with higher forecasts of more demand in 2022, with also OPEC Plus and other producers, they're sticking to low production. They aren't willing to invest in producing more. You can, if you want, you can review the number of rigs in the United States, how they're performing with higher prices. They're not as aggressive as previously. Back then, we used to see oil companies, when prices go up 20, 30%, they jump into investing in more production. They want more inventories to sell you in order to have more returns. But at the moment, they're not willing to do these investments. They suffered a lot in 2020. They went into more debt. So now they're not willing to sacrifice their profit margins on investment. And this could raise profit margins. If we have stability in oil prices for a longer period, then these companies will invest more in production. And then we could be seeing a bit of corrections in the energy sector. Real estate, as we mentioned, the reasons for real estate to move higher. So it's still outstanding. If you compare it to other sectors, real estate is just booming. And this is what's worrying a little bit the Federal Reserve, since people, they're not affording any more renting houses in the United States. It's coming a lot in their inflation figures. So that's why they have to try to normalize mortgage rates in order to lower demand on real estate, so it's more affordable again to more people. The financials also we were very far away from the moving average, and now we had a double top, and now we're moving back again towards the mean. With utilities, they were suffering, since utilities, we know that mainly utilities, they don't outperform, they're more into defensive. Investors, they go into utilities searching for dividends. They have a cap for investments. So this is what makes utilities less appealing to investors in a very risky medium, or where risk appetite is at higher levels. Industries to consider. Who's not interested in machine learning and neural networks at the time being? If we just want to go into simple example, if now I tell you I have an automated system that does trading for you based on machine learning and neural network, the idea is so appealing for you. What if we do this to different sectors? What if we convince people that machine learning and neural network can change a lot of industries? And this could create a lot of investment opportunities. So a lot of money will be spent on this sector, creating more opportunities, more value going to the going forward. And it is expected to grow significantly going to the coming years. So it's expected that this sector increases by 15 to 16% on an annual basis going to 2024. So that's what makes artificial intelligence an appealing industry to invest in. Virtual reality and augmented reality is the perfect escapism to people. So people, they go to virtual reality to escape what they are living. So these companies, the entertainment companies, they're building on this. They're investing a lot in virtual reality and augmented reality. It could triple in the coming 7 years. It's now almost around 21.7 billion, the industry. It is expected to grow to 70 billion. And we can know what 3 times in the financial markets means. So 3 folds, it means a lot going into a couple of years for certain industries. Data analytics, simply, who doesn't use data now in order to take decisions? It's not only in strategic decisions now. It's more into entering our operations, day-to-day operations. Now, most of our decisions, they are based on data. And top performing companies, they are top performers because they rely on data in order to take their decisions. So if I take decisions randomly, definitely I won't be as good as people who are, or companies who are taking decisions based on data. Cybersecurity. We're going more into a world full of technology, relying on technology, on internet, on computers. So definitely in order to secure ourselves, we need to invest heavily in cybersecurity. We definitely, when certain format or structure grows, we need also to defend it in a certain mean. And defending all what we're talking about, from artificial intelligence to others, we need definitely to defend it via a better cybersecurity. So this could create a lot of opportunities also for investors. It is not an outstanding or booming industry relative to others, but definitely going forward, it's a good defensive industry. Cloud computing, Amazon and other big companies, they invest heavily in cloud computing. Going back since 2010 to today, it's outperforming, and this outperformance is expected to continue going to additional years. We are expecting this industry to grow by additional 100 billion going into the next 3 years. And there are some expectations that during the end of this decade, companies will be spending up to $1 trillion on cloud computing. Renewable energy, so we mentioned oil, we mentioned energy, but going into renewables, we're seeing all this climate change. We've seen floods, we've seen high temperature around the world. And this is forcing many investors, many companies to go eco-friendly, and going eco-friendly means renewable energy. So that's this sector going forward in the coming years. It's a promising industry, and especially with all these Paris climate change conditions and else. So this also puts more pressure on companies to turn into more of eco-friendly companies. Also with Biden's plan for renewable energy, this is very promising for the sector. Biotechnology, genetic engineering was outstanding. This year, we've seen how vaccinations changed the world. We were going into a very deep tunnel, and then vaccinations sounded a bit better, and then the world was able to transform due to these inventions. So what about next generation treatments? Any next generation treatment that sounds appealing would drag a lot of investment to it, and this is a good opportunity for investors. Many of you will start thinking now that most of these sectors or industries could be already overstretched, but definitely this depends on how you're looking for the company. What are the conditions for your screeners? Always you will be able to find some good companies. Some companies, they are already overbought or they are overvalued, but also there will come a time where it is a good time to buy them again, and then you could follow this train. But definitely we're talking about medium to long-term investment. We're not talking about just the trading and scalping intraday like many of stock traders in the region would like to do. Growth versus value. We heard a lot about this starting the beginning of the year. Value, these are two types of, two styles of investing. Value investing, growth investing. Value investing is Warren Buffett's style, which means that we're looking for companies that we believe they are undervalued relative to their performance, their financial performance. While growth, they are where we're investing in companies who are promising higher earnings growth. So this is two diverging views. We've seen since 2008, these charts are relative to the S&P 500. So we've seen that growth outperformed the S&P since 2008. And this drop that we've seen during the beginning of the year, it was due to the rise in treasury yields. At the beginning of the year, the US yields rose to almost 1.77. It was a huge spike. Everyone was talking about the bond market. However, most of these growth companies, they rely on debt in order to fuel their plans for the future. And this makes them impacted negatively with higher yields. So this could be forming a double top formation here, going into a medium where the Federal Reserve will start tightening the monetary policy, lowering asset purchases, driving yields higher. This would definitely weigh on growth stocks. Growth stocks, usually, if you want to compare on indices, we compare between growth and value. So we can go for Dow Jones and S&P, for example, Dow Jones and NASDAQ. We have a little bit of comparison to have. So this could be a good time maybe going forward to consider buying or investing in value versus growth. So we're short on time. We're gonna go over this a bit quickly. We're gonna start with bearish, invest with bearish drivers going into bullish. So starting with the Evergrande debt crisis, which is new here. Last week, they failed to pay for international investors. And today they are expected to pay also 43.5 million, which also they could be using the grace period, the 30-day grace period to pay it, which would put them in default in case they didn't pay it in the next 30 days. So this is a very stressing factor for investors. However, if China managed to land safely the company, this could turn into a positive sentiment going forward, and all these losses could be reversed. US debt ceiling tomorrow is a very important day in the US because there is a standoff between Democrats and Republicans over debt. Republicans, they're trying to limit the spending of the Democrats, while Biden is overholding until now with his plans. Soft Q3 earnings relative to expectations, slow growth, rising inflation. We're going to talk about this going forward. COVID numbers are falling again. This is a bit positive. Now we're on 36,000 cases in the US versus 140 previously. So this is a bit positive. We have a promising holiday season, many pent-up spending. A lot of jurisdictions around the world were still closed, but now we're moving forward with more unease for movements, and this could sound positive. And Biden's massive spending plans, if they go through, they're positive. So this is the US debt. It's around 28.5 trillion. The Congress suspended or raised the debt limit more than 80 times since 1960. It's now around 28.5. If they do reinstate the debt, they will reinstate it around 28.5, which won't give the government a lot of room in order to borrow more money. So this is a bit stressful. This could be a bit stressful for the market going into October. This is the surprise in earnings during the past couple of quarters. This is due to huge spendings, huge investment, huge expansion, but we don't expect this to continue going forward, which could weigh a little bit on sentiment. These are the projections for the Federal Reserve during the last meeting. So they were expecting a better performance during June meeting at 7% for 2021, downgraded to 5.9 due to weakness in August and in September, while they raised inflation. This is a bit bad for stocks going forward. This is the US 10-year yields. We talked about rising yields. Yesterday we rose towards 156, the top of this line, and then we went back today towards 149. Watch out from this break going forward, especially if you're trading or investing in growth companies. This is the rising expectations for the Federal Reserve to raise interest rates during the end of 2022 towards early 2023. These are the cases in the United States falling again, 34,000 cases versus a 7-day average of 120,000. Let's compare a bit US to international. So US S&P 500 since 2007 had 216% outperformance, the DAX 159. So it's clear that the US outperformed others. This would put investors on a certain level where they can diversify their investments again. They can go from overstretched US market into maybe an underperforming European market or Japanese market or Chinese market. This is sound a bit worrying, but what if I tell you that China, if it continues to grow at 6.5% versus US growing at 2.0%, China will outpass the US economy as #1 economy in the world in 2029, while if at 5.5% growth and 2.5 for the US, it would happen on 2033. So this chart could explain to you why Biden is so confident and so overholding his spending plan, because due to this spending, the United States could delay this pass, and this could keep US stock market more appealing than other stock markets in the world. This is, we're gonna end with technical analysis. You can see the S&P 500 since last September. This channel was a 1-year-old channel. You can see how the retracements were towards the 55-day exponential moving average. Investors were buying the dip always. This dip was a bit stretched during September, early September, and we went towards the 100-day exponential moving average and retested it again yesterday. You can see this happened only also last September. So this is not a coincidence. We're going into a bit of a correction. The base case is for this 100-day to hold. The bearish case for the S&P going into the 200-day and the bottom of this channel at 4,200 almost. And the positive case scenario is the 4,650 going into year end and at the beginning of 2022. This is it. We still have one more final thought. If you're afraid of inflation and its impact on stocks, if you want to compare stocks to other asset classes, talking about bonds and treasury bills in the United States, the real return takes into consideration inflation. So since 1951 to 2022, the S&P or the stock market continued to outperform the treasury bond or the bond market in general. Definitely investors will still prefer a 7.5 real return to 2.8% real return. That's what makes the stock market more appealing than the bond market. And also, if we go back to 1926, the numbers won't change a lot. Still inflation, still stocks, they were able to cope with inflation. Companies were able to move this cost, adding to clients or to purchasers, and they were able to sustain their profit margins. This is all for today's session. I hope you all liked the content. If you still have any answers, we're available at booth 4. Exness do provide the ability to trade stock indices and also individual stocks, also during using leverage and the swap free. And this could be more appealing for some investors who are looking to really hold the stock versus just trading and using certain short-term trades. So this is all for my session. If you have any questions, please, I'm there. Thank you. Thank you so much. Thank you. Okay. So they don't have time for Q&A. If anyone has any question, I'm available at the fourth booth for more than an hour. Thank you, everyone. My pleasure.
Thank you so much, Wael, for that. Did you breathe during that session? Did you breathe? Thank you so much. Right, we're going to do take 2 now of this one because I want to get them back and hopefully we've sorted their presentation. Where are gold prices heading in the last quarter of 2021? Mohammed Al Mariri, Head of Trading and Strategy at Orbex, and Karina Kowalska, Head of Business Development, the Polish desk at Orbex. Please come up to the stage. Thank you so much. The big green one is your presentation.
Hello again. You know, we had some time till we fix the technical error. Now, Karina will start with you on her geometric Fibonacci presentation. Thank you.
Ladies and gentlemen, welcome to our Orbex presentation. My name is Karina Kowalska. I am head of Polish desk at Orbex Broker. I have been in the trading industry since 2014, and I'm also a Forex educator at the biggest trading school in Poland, Fibonacci Team School. Today, in my presentation, I would like to explain to you what is Fibonacci geometry and why it plays such a key role in technical analysis in trading. But let's start from its origin. The geometry of the market was founded by an Italian mathematician, Leonardo Fibonacci, who lived at the turn of the 12th and 13th century. What is the most important? Thanks to him, European mathematics, after many years of being dormant, began to live again. And his main discovery, which is the sequence of numbers, today we call Fibonacci sequence. Now let's explain the meaning of the market geometry. And the market geometry is mainly based on comparing the segments that create the highs and lows of prices. For example, we use time and price analysis, but the use of the market geometry allows us to study dependencies in both an upward and downward trend. But please remember that we only analyze the height of the sections, but not their slopes. In Fibonacci geometry, the most important role from all the Fibonacci coefficients plays two numbers, as we can see on the chart. The first most important level of Fibonacci geometry is the strongest external level of 161.8%, and the second one is the strongest internal level of 61.8%. In harmonic trading, we mainly use the levels that come from both the Fibonacci numbers and other mathematical correlations. Moreover, I would like to highlight, to explain you what is harmonic trading. And harmonic trading is a method that is mainly based and it's using specific price patterns and Fibonacci numbers to identify high return spots on a financial instrument price chart. This method assumes that certain market patterns and cycles repeat, as well as cycles and patterns in everyday life. The key is to identify them and enter and exit the market based on a high probability that the price response will be the same as historically. What is important here for us? These types of patterns appear on every time range. Before I will move to my trading examples, where I prepared for you best trading examples on gold, I would like to point that gold is by far the most popular trading instrument with the biggest numbers of traders today. Also, the current global COVID situation has a huge impact on its volatility. And this huge popularity makes that the volatility in gold is so attractive most of the time. And it gives us the ability to make our trading decisions based on Fibonacci geometry. Timing on gold is the most important, and Fibonacci geometry really provides us very precise turning points. The market simply sees them and reacts to them in most of cases. And as I said before, it happens as well at low time intervals, 1 minute, 5 minutes, 15 minutes, but also at high time intervals, 4 hours, 1 day, 1 week. And I think that really recently we can find a huge numbers of examples where gold reacted very accurate to Fibonacci numbers, but please remember that Fibonacci geometry means a huge precision, and it means for us as traders that we are really able to draw a very attractive profit from each transaction, but we will be able to repeat these patterns in the future. Now let's have a look at my first gold trade that I prepared for you. And during the whole of June, we were observing a sell-off in gold. And within 4 weeks, the price of gold went down by nearly 9%. And based on this bearish downward trend, I made my Fibonacci measurement, as you can see on the chart. And here, this upward correction was exactly 50% of the previous drop. And as we can see, after a few days, the price of gold retested the Fibonacci level of 50% and rebounded. And we can see that a typical double top formation appeared on the chart, which confirmed the weakness of the buyers. I opened totally 6 short positions. They were based on candlestick patterns, and my take profit was set up to the external Fibonacci level of 161.8%. The most important here is that these dynamic drops proved us that the market reached the Fibonacci level very accurate. Now let's have a look at my second gold trade that I prepared for you. And for the technical analysis of this trade, I use this upward bullish trend that was shaped in the first half of July. And that time, the price of gold increased from $1,750 to the top of $1,835. And after this periodic consolidation, the price of gold went down very dynamically and hit the Fibonacci level of 161.8%. And after the signals on the candlestick formation, I decided to open extra 2 long position, and I closed all my position in profit with the take profit that was on the technical resistance level. Now let's have a look at my last gold trade that I prepared for you. And for the technical analysis of this pattern, I use, as you can see here, this downward bearish trend that we were observing the sell-off in gold in June and July. And that time, the traders took their profits and the price of gold went down for a short time below $1,700. However, the losses were recovered very fast, and I used these generated increases to open my first here sell position. And we can also see that in this point, the market reacted very accurate to the Fibonacci level of 61.8%. And after, based on this bearish correction, I decided to open my another 3 short position. And after dynamic moves, I decided to close my positions in profit with the take profit that was on the Fibonacci level of 50%. We came to the last slide that I prepared for you, and I prepared for you a gold forecast. And as we can see on the chart, the current increases in gold we have been observing since August 2018. So from this point, we can see a clear bullish upward trend. The key year for gold was 2020, and the sharp increases in gold that exceeded the psychological barrier of the price $2,000. So the current correction that has been taking shape for several months is just natural. However, we are approaching the moment when the gold will return to strong gains, and it is due to the clear trend line and strong Fibonacci level of 61.8%. Ladies and gentlemen, today in my presentation, I wanted to show you my trading techniques that work very well in the gold market. We must remember that gold is a very volatile instrument, but of course can generate very attractive profit from each position. And also we must remember that Fibonacci geometry provides us very high precision, but we need very decisive movements of rates but such components are very common in the gold market. At the end, I can only recommend everyone to expand their skills with geometric methods, because if we want to become successful traders, we must be able to control our emotions, to take a proper risk management, and to think in a practical, responsible, and analytical way. I'm sure that you have a lot of questions to me regarding my trading strategies, regarding Fibonacci geometry. Unfortunately, due to the short time of the presentation, I will be very happy if you visit our Orbex booth number 6. So you will be able to discuss with me more in details, and also I will be able to show you a professional softwares that Polish trader at our trading school are using on MT4, and this professional software helps us to manage our trades much more better, and also helps us to speed our execution. Ladies and gentlemen, thank you for your attention, thank you for your time, and I hope I will see you at our Orbex booth number 6. Thank you.
That was a little surprise early finish. Thank you so much, Karina, for that. Very, very interesting. We're just lining up our next speaker, who will be Rad Al-Kheda, and he will be talking to you about how to apply savvy risk management to the markets. He's from Equity, and we'll get him here in the next couple of minutes. So just do bear with us for that.
My laptop. Working. So
what's not working?
It's like I can see my notes.
Wait, you've got that one, because I just need
All
to.
right. Can start.
30 minutes. I'll just wait till your laptop. So you have everything. Okay, ladies and gentlemen, we are ready for our next speaker, Al-Qaeda. He is from Equity, and he's going to be talking about how to apply savvy risk management to the markets. So please welcome him to the stage.
So, hello, everyone. Hello, everyone. This is Raed. I'm heading the research department at Equity Global Markets. Equity is an online brokerage firm that taking place in multi jurisdictions in the world, mainly in MENA, and we have our offices in Amman, Jordan, UK, London. We are existing also in Dubai, as well as a couple of licenses in Africa. We are the first regulated broker in Kenya, in Seychelles and Nigeria, as well as other offices around the world in the US and New Zealand. So basically, we are taking the opportunity of being here in such an event that's happening and taking place on a regular basis now, hopefully after the COVID-19 things and the lack of face-to-face meetings, we're back again to this nice habit. And also, it's we thought that it's good to talk about a very important topic that honestly was taking ringing a lot of bells in the last year and the year before due to the big amount of losses that I personally witnessed and my company as well due to the wrong risk management or the ignoring of risk management. So I take the opportunity of being in this event to speak about how critical is the risk management. So first, let me speak about this component that it means profit or loss for you to continue or not in this market. One of the most important aspects of Forex trading that many traders seem to be unaware of is that traders should not expect any particular trade to be winner or loser. There is no clear distribution of chances to know your trade gonna make profit or loss. It's pure statistics. You do your job, you analyze the market, you do the technical analysis, you take the recommendation, and you should leave it to something called risk management module, where you should accept whatever the result. But the sequence of those results need to lead after a time to a profit machine that making you profit on a cumulative methodology. So how this happen? Basically, it is far from important for you to effectively manage your money than continue to look for a better trading system. So first, you need to think about how to manage the risk, then what is the strategy? So I put a few of good questions for you all guys to start understanding how this happened. Essentially, money management tells you how many lots to trade at a given point. This is money management, okay? Risk management is everything you do before you take a trade. Money management is after you take the trade. So you need to precise your risk before even you take the actual trade. What does that mean? If I will tell you that 90% of your trading experience is risk management and only 10% for two things, getting lucky and strategy to know the trend. Could you believe that? 90% risk management, 10% knowing the trend or the direction of the trade. How this happened? By applying those two things. Risk management before the trade, money management after you do the trade. Issues addressed by money management. First question, how much capital do you place on each trade? Those are the questions. I am a trader, okay? Before even I be a market analyst, let's remove all what we speak about, company, blah, blah. I'm a trader, just like you. I've been trading in this market more than 16 years so far. Those questions that you're gonna read here are questions happened with each and every one of us. Maybe at the beginning of your journey or later, but you're gonna reach to those questions. How much capital you gonna risk for each trade? What is the heat of your trading? Capital preservation versus capital appreciation. Setting stop versus setting take profit. When must you take a loss to avoid a larger losses? Let me start answering those together in a logical way. How much capital you trade? Absolutely. If I give you a gun now and I put the target in front of you, as I said, aim to this target, and I give you 30 bullets to hit it. How many chances to hit the target? You have 30 bullets. If I give you 3 bullets, it will be less times you're gonna hit the target. Or you need to be very accurate to hit the target with 3 bullets only. Being in this market is to trade more often, not to trade less. Yet, you have to be very careful picking the high quality trades. So I need high quality trades very often. How I can do that? By reading more products, logging on many time frames, and be available with my ready to fish my opportunity from this market. How we do this? By risking 1 to 2% on each trade only. Each trade maximum, whatever you are, let's say, how you trust your strategy and your study, and you think that you are right in your call, maximum loss for each trade, 2%. Professional traders, they might raise it sometimes to 5%, and this is gonna be too much. But remember something, the golden ratio. If you are risking 1%, you should expect at least 1.61 as the profit to stay in the game. Otherwise, because I told you, 90% risk management. Forget about all the tools, how you analyze the market, and you discover the new direction. Let's focus only on statistics, only on math. Math tells you probabilities, how to enhance the probabilities. I'm telling you, if you risk 1% on the trade, you should expect at least 1.61 on this trade. This is the only way you can success and continue. If you are risking 1 to 1, then you're gonna lose. Why? Because it's very difficult to be accurate more than 50% of the time. Yes, I'm a market analyst who study this market, who has degrees, high degrees in this market, but yet I'm not 50 to 60% right in this market. I depend on risk management because I live on continuity. I live on doing the right thing over and over and use the right ratio and high quality trades only. One thing you should always keep it in your mind while you are trading. giving you the golden rules here. Capital is more important than profits. Your capital is the important thing, not the profit. So always your thinking is how to protect my capital, how to efficiently use my risk, or I risk from my capital for each trade. Apparently, you are using this capital to make money out of it. So each time you are trading, you are risking in that trade certain amount. You need to be very careful by choosing the right amount for each trade. And what is the maximum exposure to the market? Yani how many open trades at the same time they might get stop loss altogether? You need to calculate this as well, to not be in the fear of margin call or stopping out or getting out. Oh my God, my trade was good, but I don't have enough margin. My call was okay, but I didn't respect the take profit. I was able to stop my losses earlier, but I removed the stop loss, or I didn't put. You are answering the questions that more than 95% of people losing for. You are the reason. We are the reason of our losses, not the market. I can say 1 to 2% is the factor value of the market versus you as a trader and as a character, how you are trading or how you are respecting or paying for the rules. Another question, if you are on a losing streak, like strike of losses, I take a trade losing, I take a trade losing, I take a trade losing. Are you going to trade the same? No? Are you going to trade the same? It's all about money management. If your strategy is saying that you have this amount to risk, 1% per trade, maximum loss drawdown is 30%. You are following your strategy. You change nothing. You change nothing. You keep doing, you keep acting, you keep throwing and waiting to fish the opportunity. It's not about you. It's about maybe the good timing of the trade, the wrong reading of the market. It could be, but it's not about the size of your trade or how risk is your trade system is. No, it's about, did you hit the maximum losses per day? Did you hit the maximum losses per week? You should be predefined rules. You have your predefined rules for your trading system. How many losing trades a day? How many losing trades a week? How many losing trades a month? What is your maximum drawdown? Even if you have a strike of losses, you need to put a maximum number of those trades. You know, those observations and those rules, they enhance your, let's say, the actions in the market, your attitude as a trader. Because it's very difficult to control ourselves. We know this. You need the cheat sheet beside you to respect the rules all the time, to remind you, okay, today I hit 3 losing trades, and this is the maximum drawdown for me for a day. I will not trade, even if Ben Bernanke himself telling me sell the gold right now, or Jerome Powell, or whoever. I hit my limits, I stop. Exactly the same way you respect your stop loss and take profit. The same way. Your stop loss and take profit, you put them not to drag them and play with them. They called stop loss. If I will keep moving my stop sign every time, just because I want to take more risk, without any like strategy behind it, there is no meaning of this stop loss, believe me. But if there is a strategy behind moving my stop loss to the entry, if I make 30% of the target, there is schools like this. Yes, then okay, I can use this. But stop loss is something that you should care about even before you take the trade. Where is my stop loss? And we will take some time to explain to you how to put and set the right stop loss, how you calculate it, and what are the ways of doing that. Then, how is volatility handled when volatility happened? I'm a trader, always asking myself, oh, it's like today is volatility. If OMC this night, what should I do? I have open trades or I'm thinking to open new trades. How you handle volatility? Do you have rules for that? Do you have risk management rules for doing volatile day, for handling a volatile day? Usually, by limiting your trades, downsizing the size of your trades, plus, very important, stop trading where there is a news. Wait the news till take a place, then do the actions. Otherwise, you are in front of the Lord. Just like, I'm going to win or lose, I don't know. We are traders. We are not gambling here. If you are going to gamble, then I recommend you go to blackjack or do roulette or have fun, man. It's like not come to this market, burn yourself with adrenaline and do not at the end just like you are going to 50-50. Put yourself when the news are coming is not a trading opportunity. I'm telling you, trade after 15 minutes, 30 minutes. Wait the hustle to come down, then go in the market. If you are a trend hunter, if you are like a strategy trader. Otherwise, like volatility could make money, could make risk at the same time. I'm running in my slides, guys. I believe 30 minutes is not enough, but it's like an opportunity to, you know, have a little chat here and there, and always welcoming you on our booth, equity booth. Anytime you can come, we can discuss more details, but I'm trying to hit as much as I can from the slides that I prepared for. I'm jumping right away here to a very important question. Risk level among trend followers varies depending upon the size of the profit they seek. If you are seeking a profit of 100% a year, you should accept the fact of 30% drawdown. What is drawdown? Drawdown is the drop between a high in your portfolio equity to the low. This movement from the top to the down, they call it a drawdown. My equity was 100K, then my equity became 90K, then my drawdown is 10K in this case, okay? If you are looking for 100% return a year on your investment, you should accept the fact that you might see a drawdown of a 30%. This is not like science. This is by the numbers that we see. This is the probabilities. Most probably, you're gonna face 30% drawdown. This is by the numbers that we have. Most of our clients, world's clients, they do the same. If they are targeting 100K, 100%, 30% is most probably to happen. You need to navigate your way out of this 30%, and you need to accept the loss. Why accepting the loss? You accept the loss to avoid bigger losses. What does that mean? Cut the loss to chase the profit. So cutting losses, chase the profit is the key in this trading game. Decide the risk on each trade relative to your entire portfolio. So we said 1 to 2% is from your balance, you should put your stop loss. A reason to keep this number small is to protect yourself from a series of losses. It's okay. You lose 6 trades in a row. It's fine. There is some trading strategy built over 6 trades in row, losing, and you keep continuing. It's fine. Because it's about odds. It's about probabilities. It's not about you are right or wrong, or the market is going against you. The key is to limit those losses so that you can endure a string of them and have enough capital to place trades that will be big winners. So you have the chance to be in the market later. So how to determine risk per trade? Here, it's about the position sizing. The position sizing. So how big is my position is defining what is the losing percentage. So for example, if you are selling gold, okay, and you are saying that I want to sell gold and my risk is $200. This is called financial stop loss. Financial stop loss as a percentage from what I own. I have $5,000. This is my account size, and I'm willing to lose for this trade only $200. What does that mean? If I took one lot on gold, it means $2 the gold go down, I hit my stop loss. But does that $2 is good number from technical point of view, from trading, from product point of view? No. Why? Because it's very close. $2 is very close. So what I have to play with the size of my trade to give myself a bigger break. So instead of putting my stop loss at, let's say, 1798, while I'm entering the market at 1800, I can push it $5 down or $6 down, okay? Or $8 down. It will gonna be 1792. In this case, my trade size, it will go down from 1 to 0.2. In this case, I can stay in the market because the product plus the financial stop loss together, they form my stop loss. So I respect the 2%, and at the same time, I respect the nature of this product, how it is moving. So for gold, $2 is not enough. We need $8 minimum to protect ourselves during a day trading. Plus, we respect the size of loss per trade, which is not less or not more than 2%. A lot of stuff, but quickly I want to hint about 2 things. So the trading account, you see the drawdowns. The drawdown is the distance between the top and the low. The top and the low is a drawdown. So we start from top, we go to down. This is a drawdown by equity. Here, number of trades. Here, the trading account as equity. So this is how we see. Drawdown should be limited, should be short. So the game here, I'm playing on risk management only, ignoring everything else, focusing only on building a strategy that we use for risk management. Let me introduce 3 strategies that I can speak to you whenever you want, guys, on my booth. Those 3 strategies: short selling as a hedge to a physical investment, negative averaging strategy, and multi-angle strategy. I built those 3 strategies. It's like very doable, very achievable. You can do them as a normal trader. Those 3 strategies, I'm happy to help you on our booth to explain more about each one of them in details. And I want just to tell you that The last one, which is the multi-angle, is just like a developed strategy that already written in books that we add to it, that it's depend on dividing your capital into pieces, and each piece you're gonna lose after certain amount of strike losing trades in row. So for example, let's say you divided your capital into 20 pieces, each piece you lose it after 7 trades losing in row. Each trade losing, you double the size in the trade after. The concept here, it's about the quality of the trade to choose high quality by better ratio, plus respecting the sequence of your losing trades. I'm happy to send this presentation to all of you. Whenever you want, you can visit us on the booth. I know it's very limited, 30 minutes, a quick, let's say, takes we take here. I would like to thank you everyone for attending this session. Hoping to see you soon, visiting us on the booth as well in our offices in Dubai. Thank you so much. Appreciate it. Thank you.
Thank you, Raed, for that wonderful presentation. Fantastic stuff. Lots of learning there, that's for sure. My brain is imploding with the information that I need to take in. Up next, our next speaker is going to talk to you about how to use AI and machine learning in Forex trading. Please welcome up Nitesh Sharma. He's the CEO of TP Global FX. Come on, guys, let's have a little bit of energy in the room. You're all falling asleep today.
Thank you.
So just the big green one forward, and that's a laser pointer if you need.
Okay, thank you. Good evening, everyone. I don't need this. Hello. Is this working? Yeah. So good evening, first of all, and I would like to talk about what is machine learning and artificial intelligence and how you can use it in Forex. So a brief background about me, I'm a data scientist and I've been in the Forex industry for the past 14 years. So here I'm going to talk about how do you actually start doing this? You must have read a lot of articles about, that AI is changing, it's revolutionizing trading and all, but do you actually know how it happens? So this issue I'm going to address today. I'll be talking about it. So let's start. Artificial intelligence. What is artificial intelligence? The word speaks for itself. It's intelligence which is artificial. What we try to do in artificial intelligence is basically make the computer do the brain-like work. Like the human brain does things like, you visualize, you see, you hear. So all this is processed by the human brain. So in artificial intelligence, what we're trying to do is give machine the tools it needs to act like a human brain. Now, that's about artificial intelligence in very simple words. I'll try to keep things very simple, very non-technical, because if I get technical, it becomes a very big data science class, which I don't want it to happen. Now, talking about machine learning, the machine is learning. We try to feed in the data inside the computers, inside the algorithms, so that it can learn from it, keep it, and learn again and use it. Now, algorithms. We've all heard about algorithms. But what are these algorithms? Very simply, they are nothing but just commands given to the computer to act in a particular way if something happens. Like if I tell you, if you want to go out, you get out, you go straight, take a right, then take a left, and you will reach your destination. Same way, we are now talking about programming the computers in a particular way to collect a particular type of data and to do particular things. So that's about machine learning. I'll just go through the definition. Machine learning is a branch of artificial intelligence where the machine analyzes the data using algorithms, which are nothing but steps from that analyzes the machines. It stores itself, and next time when it analyzes, it uses the first data. Like I said, you like if you want to go from place A to place B, you look at the road once, you will remember part of it. You go to the road again, you'll remember the whole of it. Same thing. Next. Okay. So now let's get to Forex trading. What are the basic problems in trading? The first and the most important is the entry and exit. When do you enter into a trade and when do you exit a trade? If we all knew when we could enter a trade and exit a trade, we all will be millionaires. If we could just get that perfect timing, that when should we enter and when should we exit? Because a lot of times you must have seen that, when you enter a trade, the trade has finished its move. Or when you exit a trade, from that point of time, the trade goes in your direction more. Be it if you book the trade negative loss, if you book losses or you book profits. So this is the biggest problem in any trading world. It's about entry and exit. All right. So now I'll talk about this. Next up, analysis. We all, it's all about the technical analysis we do, the tools, all these things that we use. Before I proceed, my next question is a very simple question. How many of you are an analyst here? If you could raise up your hands. Anyone is an analyst here? None of you are an analyst? You're an analyst, sir? What type of analysis do you do? Sorry? Technical analysis. So you sure you're not an analyst? You never done analysis in your life? Have you done analysis in your life? Have you done analysis in your life? My friends, every single person sitting here is an analyst. I'm not talking about analyzing the charts. We all analyze day in, day out. Everything we do is based on analysis. Just to give you a simple example, if you are on the Sheikh Zayed Road and if you see a biker going on very high speed without a helmet and cutting through cars, what is the first step that comes to your mind? That this guy's gone crazy. He may lose his life. He doesn't know how he's driving. Am I correct? You'll be like, God, this guy's actually crazy. What have you done? You have analyzed that, so and so thing can happen. How? Based on a pattern. Because you have seen in the past that if this is the way someone drives a motorbike, all right, if he drives rashly, then there's a possibility you have seen that, he or she may lose a life. So based on the pattern that you have already stored in your brain, you analyzed that so and so thing can happen. Let me give you an even more simple example of humans being analysts. When you look at a small kid, a 4-5 months year old kid, I'm sure all of you have met someone. So the first time you go to the kid, what does the kid do? It cries. Am I correct? The first time you go and try to hold the kid, 99% it will cry. And why does it cry? Because if, the thought process goes this way. The kid cries because the kid knows that if I cry, my mom or my dad will come and pick me up. So at that tender age, the kid has analyzed that if I need something, I have to cry. So here I'm trying to talk about how the human brain actually analyzes things. Everything that you're doing right now, you're analyzing. Just as a few of you out here analyze that, we are tired walking, we can come and sit here, there'll be nobody to disturb us, and we can even take a power nap. You analyzed. All right? I spoke about patterns. All right? Let's proceed. How does the human brain function? I just spoke about it, that you keep on analyzing day in, day out. Excuse me. Now, you guys must have heard this word called as neurons. They're these tiny, very tiny particles in the brain. So what do these tiny particles do? They are nothing but just messengers. All right, like if I give a message to you to please pass on a message to him, to listen to me. So same way, that's the job of a neuron. it passes the message from all over the body. And when you connect two neurons, and when you connect the third neuron and so on and so forth, you make something called as a neural network. We all understand a network? So you keep on connecting neurons, you get something like a neural network. Now, why am I talking about a human brain? The topic was artificial intelligence. Why am I getting into the human brain? Because here, what we are trying to do with machine learning and artificial intelligence is to make the machine think like a human brain. What reference do we have? If I want to actually make a brain, what is the first reference we have? Are we going to use a monkey brain? We don't know how a monkey brain operates. We can analyze or we can predict, but we actually don't know how a monkey brain operates. So what type of brain do we know? We only know about a human brain. Now I can't have a monkey come and tell me that, okay, listen guys, this is how my brain operates. But we only know about human brain. That's why I'm talking about a human brain. And from here, I will take it further to the artificial intelligence part. Now, I spoke about the neurons. They are basically just messengers in very simple words, not getting to the biological part. And I spoke about a neural network. Next question. Do you know how many neurons are there in a human brain? Anybody, any wild guesses? How many neurons? How much? Trillion, absolutely. A human brain has over 1 trillion neurons. 1 trillion neurons. Hold on to this number because it's a very important number. Now let's get to the artificial brain that I was talking about. Now we all have heard about artificial intelligence, artificial brain, and that the computers will take over, the robots will take over. We've seen a lot of movies coming into it. We've a lot of theories of Siri listening to our talks and recording our talks. All that is okay. Let me just give you a simple example. The biggest neural network or the biggest artificial intelligence program that has ever been made till date contains 15 million neurons. And that is in a supercomputer. So if I am going to give 1 trillion neurons to an artificial brain, to a computer, it will require all the computing power of every single mobile phone, every single computer in the world. Along with it will require the electricity from every single household. So the human brain is way, way, way much better. We're trying to develop it, but it was, I don't know. I mean, I would not like to say that the artificial brain can never become as better as a human brain, but let the conspiracy theories be aside. The human brain is a work of art. An artificial brain is a work of man. There's a big difference. Now, same way, just as the neurons carry message from one part, the neurons actually pass message in the human brain. Same way, the neural network and the neurons in the artificial brain, what we have given, it is a function. It is a mathematical function. All right. What it does, it basically computes. It basically analyzes. It basically, computes. It's a mathematical function. Now, like I said, you cannot keep on adding more and more neurons because we do not have the electricity in the world till now to have something as close to a human brain. Now, you must understand that the artificial brain is made very similar to a human brain. Let's continue. So we understood about that, listen, we need what does a neuron do in the human brain as well as artificial brain. Now let's get to the data. This is a very important part because it all comes down to data. Now, how many data points can a human brain analyze at one point of time? Now, when I look at all of you, or when I talk about myself here, what are the things that the human brain is doing? You're breathing, you're listening, you're looking, your heart is pumping. So many things are happening. At one point of time, your brain is doing over 1,000 functions, or probably 1,000,000 functions. All right. So, and it's diversified. It's not doing one function only. All your neurons are just not looking, okay, you're sitting in front of a computer, you're looking at a graph. It's not that you're only looking at one part of the graph. You're looking at so many other things. You're looking at the market watch, you're looking at the terminal, you're looking at the ticks. So what happens is the human brain, even with 1 trillion neuron, cannot actually focus on one thing, cannot actually have the full focus going on one thing. We have 1 trillion neurons, all right, but we cannot have the full function, the full potential, just look at that one point. It can't be possible. It's not possible till now. And that is where the difference comes between the artificial brain or artificial intelligence and the human intelligence. When you tell a computer to do a particular thing, that listen, if the market comes at this rate, you buy, or if the market comes at this rate, you sell. It is only going to do that. Now, how do we use the artificial brain or the artificial neural network or artificial intelligence? Does anybody know when did the Forex market start? Any idea? How many of you have used a MetaTrader? Are you very well versed in MetaTrader, sir? Anybody who's used MetaTrader quite often from some time? Anyone here? You, sir? Yeah, you do Fibonacci analysis, so you know. So when you go to the account history, the custom period, you can choose the range from where you want to see, right? From which date to which date you want to see. So what is the date you get to see? 1970? The first date? Sorry? 1982. Let's take it as 1980. So the Forex market is working since 1980. All right. So if I tell you that, you know, sir, what's your name? Azim. So if I tell you that, Azim, sir, what I want you to do today is look at the 1 minute chart of Euro USD from 1982 till today. Possible? You have 1 trillion neurons, my friend. Is it possible? How much time will you take? Sorry? So he says it can't be done. But okay, let's get into the theoretical part of things. If I tell you to look at the markets, the 1 minute chart of any currency pair for 30 years or 40 years, you will take at least a month. And with a lot of breaks, and you will keep on forgetting. This is where the artificial intelligence algorithms comes into a play. If I put the code in the system, if I put the data into the system, and I tell the system, listen, these are the 4 things I want you to do it for me, and give me some result. What it will do, it will keep on processing, keep on processing, keep on processing, keep on processing, and give me a result. This is the difference between the artificial brain and the human brain. Now, you understood this, that, okay, we have the data, we got to put in, and you know, it will crunch. But what will it crunch? What are you looking for? What was the basic problem in Forex? The first thing I spoke about, excuse me, the basic problem in Forex, the entry and exit. So what the AI algorithms can do is, it can find you newer patterns. What you got to do is take the data, put it into an algorithm, and give it a small intuition. The computer will work based on what you tell it to do, what you tell them, what you want it to do. Now, if you want the computer to find out something, it will do it. That basically means that you are telling the computer, you have to give it something called as an intuition. So you tell a computer that, listen, I have data from 1980 to 2021. Take it, find me a new pattern, or tell me what happens when Euro USD touches 1.50. Anything. And tell me how many times it has touched 1.50, or how many times does it touch 1.10, or like, let's say, if it comes to 1.20, 1.120, how many times does it go down or how many times does it go up? Just put that in and you will get a newer pattern. Now, take that pattern. Ask another question. Keep asking questions and then you get it all together. So there is a program called as reinforcement learning. In reinforcement learning, what the algorithm does is that if you tell it to do something, it will do it. Then it will store that pattern. Then you ask it to process more, it will store more. So that's what you got to do. Tell the data that, listen, I have a strategy. Will it work? Or what happens if if the market reaches this level or market reaches that level? That's what you got to do. You got to give it to the computer and let the computer do the work. You sit back, relax, and just watch the patterns come to you. And once you get the pattern, you make newer strategies. So this is basically how you can use AI and ML in Forex. Now I'm going to talk about what is being happening. I gave you a basic intuition, basic idea about what is the human brain, what is the artificial brain, how are they similar, and what you got to do next. So what is happening now? How is AI and ML changing the trading world? Newer patterns are being formed and recognized every day. We don't even know about it. All right, the work done by these hedge funds on day-to-day basis is hidden from the world. The amount of computing power that they're using, it's hidden. Newer patterns are being formed. All right. The use of ML to monitor pricing in real time has led to greater transparency. ML algorithms can make buying and selling of lots automatic in Forex market, thereby proving traders with edge of speed and precision. You must have seen in the past few years, past couple of years, that the speed at which the trades are executed has increased drastically. That's because of AI and ML. There are algorithms which have been made to predict whether the trend is going to go up or going to go down, all based on the mathematical numbers. The algorithms, neural networks are used to classify if the strategy is going to be positive or negative. Basically, you have a strategy, you take a data, put it in the system, all right, let it run, and it will tell you whether the strategy is going to make you money over a long term or is it going to make you losses. It's a classification problem, because now if you how many times can you test a strategy? You would test a strategy like, say, 10 times, 20 times, 100 times, 200 times, not more than that, before you put in your real money. I am talking about testing it more than 10,000 times or 100,000 times, because now you have a data from 1980. So here, this classification, whether your strategy is good or bad, you don't actually have to wait for weeks. You can get it probably in a day. And then you can keep on making it better. So again, now when you know that your strategy is good, when you're making the algorithms think more and more, work more and more, you can actually keep on making the computer learn, give it more and more feedback. So you work on the feedback the computer gives, and you can actually get better entry and exit points, and you don't have to worry. Your algorithm is going to do that. You know that your algorithm has given you that, okay, based on this strategy, you enter here, you exit here. And this now would not have been tested 100 times, 200 times. It would have been tested over 100,000 times. This is basically how AI and ML is changing Forex now. And this is how you can actually use AI and ML in Forex. That's about it. Anybody has any questions? Anyone, any questions? All right. Thank you very much. Thank you.
Thank you so much to Nitesh Sharma for that wonderful talk there. Very, very interesting and lots of insights as well. We'll crack on straight to our next speaker. Who's going to be talking to you about the financial crisis, gold and climate change. From XTB, I'd like to welcome up Farah Mahmood. She is the senior market analyst at the company. Farah, if you'd like to come up, please. Sorry, Farah Murad. I can't even read my own writing.
I'm just trying to see if the mic
Apologies.
works. Okay, it does.
So bring it forward. That's a laser pointer.
That is for what?
This is a laser.
Oh, it's interesting. Okay. All right. Hello, everyone. It's a pleasure to be here today. It's Farah Murad, Senior Market Analyst for XTB MENA. We're very happy to be here with you, and hopefully we can shed a little bit of light of what would happen in the markets in the upcoming future and help you take smart, hopefully, investment. So as it shows, we're going to talk about economic instability, gold, and climate change. I just want to have a question really quickly asking you. Do you believe that we're heading towards a financial crisis soon? Yes or no? You can raise your hand if you feel like this is a potential scenario that's going to happen in the financial markets. So just one person. Okay, that's a bad sign, actually. 2%. Okay, so, you know, whenever there's a bubble happening and a crisis just around the corner, it's usually when the markets are looking the other way. And whenever we fear a certain crisis, it's actually a good thing in the markets because, you know, we're fearful and crises don't happen when we're fearful. And I'll just move to one of the main or most beautiful quote that I've heard in the financial market, which made me actually fall in love with the market. It's, if you watch close, history does nothing but repeat itself. What we call chaos is just patterns we didn't recognize. What we can't read, we call nonsense. There is no free world, there's only patterns. So the thing is, everyone here is just trying to decode patterns to know how to trade better. And this is what we will try to discuss today. If you can see this picture, for example, here, what do you think have in common? These are all crises that happened throughout history. And they started, the first recorded one was in 1772. And then we have the Asian crisis, we have, you know, the Great Depression, we have the stock crash in 2008. And they all have one thing in common. Any idea what that would be? It's human greed, actually. They all have that in common. And this is mainly the biggest risk on the markets, human greed, short-term greed. And this is why we believe that a potential bubble is actually in the making. There's a lot of characteristics to this bubble. And what we are witnessing today, there's many of these characteristics that are present. First and foremost, it's put-call ratio. We're having it at the lowest. It's something related to option, but if you want to probably see the alternative of that in the financial markets, let's say RSI index, it's at the highest level. It's a huge bullish market. The other sign for a bubble that's in the making is actually brokers, let's say option brokers. They need to hedge their retail client position. So they actually buy more stocks and they're making this trend go even higher. The other thing to take into consideration that all of this, you know, bullish market is also created by the federal bank, the liquidity that is injected in the market. It's not really based on the fact, you know, the healthy economy, we have huge demand, the prices are going up, the stocks are going up. No, it's basically mainly based on the fact that the federal bank is just injecting more cash in the markets. And the last and probably one of the main characteristics of a bubble in the making is actually that there's a lot of IPOs, new listed stocks in the market. We're hearing a lot about hot stocks, and that's also not really good for the markets. And I've seen now a lot of people just don't think that we are in the middle of the crisis. Probably we're all waiting for a new times high, probably on the stock market, and this is a bad sign. This is probably, we are moving into, you know, a speculation bubble. bullish market created on the fact that a lot of people want to make more money from the bullish market that we're seeing. So what happens now? We already saw a huge spike in inflation rates. And this inflation is not really created by the fact that there's a huge spike in demand. It's just because there are a lot of liquidity in the market that's making the prices go even higher. Another sequel or aftermath of this high, crazy bullish market is the US recovery track. I will show you that even though we have the most aggressive plan to try to fight, the post-COVID recession, we are still way below pre-COVID levels. And the negative data pushing bulls to buy more. I will be discussing this further. For example, here we have graphs showing US recovery track. And we can see in most industries, even though we see the federal bank and most of the central banks trying to inject more cash in the market, we are still not back to the level pre-COVID, whether it's in finance, mobility, production, employment, demand, health, we are still below pre-COVID levels. At the same time, the consumer card spending or the consumer behavior, we are still not spending a lot. We are still fearful. So even though the inflation rate is getting spiked up, there's nothing to back this when it comes to human consumption or consumer spending. The other thing that we are witnessing as well, the more bad data that we have when it comes to economic indicators, the more bullish the market is getting. For example, let's say when we had the non-farm payrolls in August, we had really bad non-farm payrolls data, but we've seen NASDAQ, for example, reaching all-time high. That is based on the fact that the federal bank is kind of, or have to, keep on helping the market as long as we have negative data. And this is taken as a more bullish sign for the markets. So the more bad we are, we're more in a bad condition we are, probably the federal bank needs to help us more. So that's a buy sign, which doesn't really make sense. So what now? Do you feel like maybe you are heading to a bubble or not yet? Okay, so we've been all discussing or talking about, kind of recovery that we will see, post-COVID, whether it's a V-shape, U-shape, L-shape. We heard all kinds of alphabet shapes. It seems like we're seeing actual recovery in certain industries, while other industries are actually still suffering. So most probably, I would say, we are in a K-shape, where some industry are recovering, others not quite much. And here's a fun photo of, Jerome Powell, who has probably the most powerful weapon in his hand, just print more cash, facing Superman. So we are in a situation, as I said, bad is good. The bad data we have is actually a buy sign, which is really not the way that economy should work. Economy should work as simple as we know. A rise in demand should have a rise in prices, and that's as simple as it gets. So now we know that the moment we hear the federal bank is saying he's gonna cut on cash or he's gonna just reduce the liquidity in the markets are taking it as a sell sign, even though all of this plan was supposedly not to have a bullish market, simply just to survive the markets during COVID. And we see shift on the FX market. The moment that we've heard that probably the federal bank is going to cut on liquidity, we've seen a spike on dollar. Is that correct? So basically that would be also a bad sign for stocks, where we might see, deeper correction at the moment. There's a very nice, I think, sentence said by JP Morgan regarding gold. Gold is money, he said. Everything else is credit. Who believes in that? Just one person as well. Okay, so why do we think that gold is the safe haven during crisis? There's a lot of reasons behind that. First and foremost, it's an anti-inflation asset. Whenever there's a spike in inflation, it means that the dollar you have or any cash that you have is not gonna have a lot of value. If you want to save your capital, you need to switch it to another asset that would allow you to reserve this value of the capital that you have. And this is why over thousands of years, it showed that it's an asset that can survive the test of times. And this is why it's still considered as a safe haven. The other thing that makes gold shine during crisis, it's that its price is actually not based on speculation. There's no, the value is in the gold itself. And this is why it can still be considered as an asset during crisis. And, okay. And if we can see that the monetary policy, I don't know if you're aware of that, but the federal bank is trying to cut on their purchases for bonds. And at the same time, probably during next year, he cannot, until next year, reduce the interest or increase the interest rate, which means that the stress on the dollar is going to remain for a while. And the more stress we have on the dollar, the better the gold would perform. We're all aware of that or not? If you need me to explain a little bit more, because you know the gold or any other commodities, they are priced by dollar. So the moment, even if there's nothing new in the market, the moment dollar goes down, we can see a very positive effect on the gold markets because it is valued in dollar. Okay, so even when we're checking the technical analysis or the geometry of the markets, we have seen a deep correction since it hit its all-time high. And we think that this correction might stay for a while. So whoever is bullish on gold, we think it could be a good opportunity for you to start, you know, considering it as a hedging against inflation. And we can always look on what the Fed is saying. The federal bank is gonna do any new policy that would strengthen the dollar, we will see directly the effect on gold. It would go down whenever the dollar is strong. It will go up whenever the dollar is weak. And there's one thing that's here in XTB we offer our clients. I think it's very important to look at. It's our platform, XStation 5. Have a look at it because let's say you're trading on gold and you want to see the effect of news directly on the market instead of having, you know, just the economic agenda in front of you, the chart in front of you, and just seeing where things, how news are affecting the market. You can have it right on the chart. Any news that you want, you can see if it's high importance, low importance, and you can see how it's exactly changing the chart and affecting, you know, even the candle at the moment that the news are, out. Have a look at it because even XStation can have instant market updates, instant market analysis, the economic calendar, as I said. It's quite interesting if you care about the fundamentals that might affect the market. Okay, so now we have new risks, new territory. I think this photo is quite disturbing. Do you know whose eyes are these? Okay. Yes, correct. Okay, so what are these new risks? We are aware that we're moving into a territory where already the markets are over flooded with artificial help. We already know that even if we manage to pass this period without having a crash or a huge recession, we are still not really in the best, I would say, you know, rhythm of the markets. So what if just right around the corner, we have a new risk that would depress productivity and would divert, you know, the capitals of big companies from actual production to less productive aspects. A risk that would increase public debt. It already cost us in 2019, 146 billion loss. Already cost the security, the insurance, bill, 60 billion. And costing 1 trillion from global GDP. So how do you think we can overcome all of these, even though we are already moving from an actual crisis? All of these are actually happening. And do you know what crisis or what risk that is? Climate change. It is actually affecting the market. It's not just a thing that we hear on the TV, it's actually affecting the market. And what we're trying to discuss today is the potential of you rethinking your investment plan based on that. So what's the forecast for climate change and its effect on the economy? Banking crisis would rise by as much as 248%. Having financial crisis would rise double, it would happen by double time. Like let's say every 20 years we have a crisis, we might have it every 10 years. It would impact 48 countries, which represent 90% of the global GDP. It would be responsible of 50 to 80% of economic losses. World economy is set to lose 18% of its GDP because of global change. China is probably one of the top, even all Asian countries, all Asian economies would probably be hit the most. China would probably has around 24% of its GDP wasted on climate change. And then we have US close to 10%, Europe almost 11%. So imagine we're spending that much on things that doesn't really affect productivity or expansion. It's just that we need to change the way that we're doing things so we don't affect the climate. Are we moving towards an economies where everyone is on its own, deglobalizing the globe? Because, you know, the US, the Europe, they don't need to be part of a bigger plan, for example, to help Asian countries to solve the problem. While this is still an issue to debate, but we should take it into consideration that maybe every country would be on its own, would see like, no, this is my own issue, I will deal with it. It would cost me less than actually working with another country to solve the problem. So here's a map that would show potential lawsuits against companies that are affecting climate change. And imagine if it goes really big. Imagine if there's a lot of huge companies that are, you know, going to court because of this. It would definitely have its effect on stock markets, for example. We can see more stress happening in the stock market. Price of net zero emission, until now, we can't really figure out how much it's gonna cost us to have a net zero emission. There's rumors that it would probably cost around 38 trillion per year, and we're still not sure about that. Increased losses to economies that, you know, we're already using, you know, the liquidity that we have in the markets, quantitative easing to pass through the risks that COVID added to the markets. So imagine if we're going to be hit by another risk. How can we survive that? Another quantitative easing? Climate change should be at the center of our investment plan. How can we do that? Are you interested anyway about it? Did you change your mind about, you know, the future territory of the financial market? You're saying no. Can I know why? Can you please comment? I would like to know why you think this would not affect the markets. Okay. So how about, let's say, in commodities right now, energy. We're seeing a spike in natural gas. We're seeing spike in oil, all because, let's say, there's a hurricane happening in Texas that it's affecting production. Even the natural gas in Europe crisis is based on actual issues of climate change. And we're seeing spike in these prices right now. Honestly, I cannot hear you well, but I would love to have discussion with you at my booth. It's XTB Mina. I'm waiting for you to discuss this even further. Okay, but I do believe that, you know, being forced to create an infrastructure that is, you know, environment friendly, that would change the way that we would invest in the future. Having all these effects, let's say all the floods that are happening that would affect insurances, it would create a whole different, you know, environment for how insurances work in the future. So I think it would definitely be a huge effect on the markets. And it would create possible opportunities to move beyond the COVID crisis. For example, if we want to think of ways or opportunities to move beyond the COVID crisis, if we start right now on the short term, we can create opportunities, innovative plans, create more jobs by moving from, a high emission carbon industry into a more friendly one. Imagine the number of, the jobs that will be added simply by switching the way that all of these industries are working. As on the midterm, creating new sources of growth and sustainable territory for investment. On the long term, though, I think it's the only way for us to survive on the planet, whether it's for the financial markets, whether it's our private life, and everything in between. That's pretty much it. If you have any questions, we would be very happy to have you in our booth and discuss further all the opportunities that you would think of. Thank you so much.
Thank you so much to Farah for that wonderful presentation. Good stuff. We're now going to take a short break for a coffee. And if we can come back here just before 5:30, where we'll be getting into a panel discussion on different trading instruments that constitute multi-asset trading. And then we will have another 4 presentations up to about 7:30. So we've still got 5 to come after the coffee break. So if we can get back here just before 5:30, that will be great. I'll give you an opportunity to stretch your legs and get some caffeine. Thank you so much. Good evening, ladies and gentlemen. We are still here at Forex Expo Dubai 2021. We'll be getting our panel session underway in Hall 1 very, very shortly. The topic is going to be different trading instruments that constitute multi-asset trading. That panel session will be underway in about 10 minutes time. So if you'd like to make your way into Hall 1 to join us, we'd love to have you. Thank you so much. Welcome back, ladies and gentlemen, to Forex Expo Dubai 2021. And we're going to get straight into this panel discussion, which is going to be on different trading instruments that constitute multi-asset trading. And if we go down the line, gentlemen, if you'd just like to introduce yourselves and tell us a little bit about your companies. G2, if I can start with you, please.
So I'm the CEO and co-founder of DIFX. We are a cross-asset exchange. Our main focus was cryptocurrency, but since last 1 year, we have integrated MetaTrader 5 along with that. We are allowing users to trade. What we have seen in past 4 years, there is a massive volume which was happening on cryptocurrencies. We have seen this market growing from $200 billion to $2 trillion in last 1.5 years. And we want more and more users to trade different assets. So we created DIFX as a cross-asset exchange, allowing users to trade cryptocurrencies along with the traditional assets. We have the strongest custodian at the back end, which handles the wallets, and we allow users who are trading in Bitcoin, Ethereum, USDTs, they can cross pair and they can trade on traditional assets. So that's what DIFX is.
Okay, Ziad, if I can come to you. Hello.
Hi. Ziad Malhem, Chief Business Development Officer at Amana Capital. We're simply a multi-asset, homegrown broker from the region, serving the region. A main focus on servicing retail clients all over the MENA region. We're one of the most regulated brokers in MENA.
And Mohammed?
My name is Mohammed Amr. I am the Business Development Director in Forex. The company has been happily involved in the Forex industry for the past 15 years. The last 2 years, we are heavily getting slowly into the Middle East, and hopefully would be there for years to come.
And you know it's going to be the Irish name that I mess up, isn't it, Mr. Ferguson?
I was going to let you try it without actually telling you, just to give it a go, but it's Dara. My name is Dara Ferguson. I'm the CEO of Avatrade. Avatrade, like yourselves, we're in our 15th year, so we're one of the longest established brokers in the industry. And one of the most regulated brokers, not just in the Middle East, but in the world. We're regulated by 10 different regulators around the world. So you can imagine the amount of fun that comes with.
So first of all, I want to ask you all, what are the top choice asset classes that we're seeing from traders in the Middle East that you've noticed most recently? G2, if I can come to you first.
We are a cross-asset exchange. So what we have been seeing that the traditional traders who are trading Forex, commodities, they are more and more inclined towards getting the exotic pairings. And on our exchange, we see lots of people doing a trade. We have exotic pairings of gold to BTC, Ethereum to copper. So this is what exotic pairings we have. And we see a sudden change in the last 6 months wherein the cryptocurrencies have grown to next level. And more people are inclined towards cross pairing, and they are trading BTC gold, silver with Ethereum. This is what exotic pairings we see that mostly traded on our exchange.
Ziad, what are you currently seeing?
If we look at it, if we look at the business, when it comes to the multi-asset classes that traders are focusing on, if we look at it as a pie, since 2017 until 2020, we saw a change in behavior. Like in 2017, for example, the share of crypto assets as an asset class used to be big because there was a boom in 2017 in crypto. And that share of the pie, of the total pie, started to get smaller and smaller until early 2020. However, the end of 2020 and early in 2021, there was a really big spike again in crypto because of the market movement and because of the volatility. However, if we look since 2017 on currencies, we see that it's still steady. The demand is there, it's solid, but the share of the total pie when it comes to the asset classes is remaining the same. Until 2021, it's still the same, although there might be some spikes because of some news or because of some economic events. Now, what's interesting is in commodities and in stocks. And when I say stocks, we're talking about the stock markets as well as the indices as well. Commodities and stocks, since 2017, there was a small market share when it comes, there was a small share when it comes to the total, to the big pie of the asset classes. However, it started to increase bit by bit until we reached the end of 2020. It reached to a peak, and 2021 was even more. So currently, in 2021, I would see demand decreased a little bit on currencies. However, we have crypto in the second half of 2021 decreased, unlike the first half of 2021. But commodities, as well as the stocks, there is big demand. And I think when it comes to commodities, it's driven by gold and oil movements mainly. When it comes to stocks, it's driven by the indices mainly the US market indices as well as a couple of European ones.
And Mohammed, what have you been seeing most recently?
Okay, Middle East traders generally are among the most affected within the industry. They pick on trends. They are always involved in picking on gold when gold, goes in fashion. But also when things have changed, as Ziad mentioned, 2017, the spike with cryptos. They were among, the most heavily involved. Again, they followed, of course, the trend, and they kind of pulled out from the cryptocurrencies for a while. Now they are again heavily into the cryptocurrencies. And as they had actually mentioned, they are also slowly getting more of the pie into the indices. That's for sure. I totally agree with this point.
And Darian, what are you seeing?
Yeah, I think the guys have probably covered it quite well already. And Zayed, I think you said exactly 2017 was the crypto boom, died away. Since then, if you look over the last 3 or 4 years, it's roughly, I would say, like 30-30 split between FX, commodities, gold, and then indices and options, if I categorize them together. The markets are cyclical. So you'll always have something that drives to the forefront of the market, be it from economic, be it from whatever influences that are coming in. Last year was unprecedented, when we all saw what happened in oil, and as you mentioned, Mohammed, the oil went crazy, and the Middle East market is the one that drives the world oil. So there's a big influence that comes from here, but then that dies away and it's replaced with something else. Stocks then took over as the bottom out, and everybody looked at them to try and get more options, more stocks on their platform to service that huge demand that's coming out there. We all saw what happened with Reddit, I'm sure in America, with AMC, all that kind of stuff. And there was a huge drive by all the brokers. I got to get more stocks on my platform quickly because that's fueling what investors want. And ultimately, we are here to service what our clients want and what they want to trade. The last thing that I would say that we are looking at, and I think it's something that's new coming to the market and we'll probably cover a little bit more, is options trading. We've built an options platform. At the minute, we're focusing on FX options, but it's like real vanilla market options. And we're starting now to leverage that into indices, oil as well, because again, the demand is coming from there, driven from what happens in the States, which is very much an option market. And now that's filtering into Europe. And I think that's Europe and the Middle East. And I think that's going to take over in the coming years.
Seeing as you've kind of touched on it there already, I'll do the follow-on question. How do you see the European and Middle Eastern traders differing in what they're choosing to trade in?
The big asset classes that everybody trades, it's always gold and oil. The US indices take predominance, I think, over anything else. Europeans will look at their own European markets. DAX is the biggest traded instrument in Germany, of course. In Ireland, we have the Isaac. So everybody will trade a little bit of what they know, what's close to you. And when you trade stocks as well, you trade the stocks, you trade the big stocks because Tesla and Facebook and everybody hears about it. But also, about the little stocks close to home. And, I want to buy a little bit of Bank of Ireland, or I want to buy, from a UK, I'll know exactly, or if here, I'll know what stocks I want to trade here. And that's again for the brokers that we need to be able to ensure that your marketing as well as your platforms are catered to the different segments in which you think, because there's no point coming to the Middle Eastern market with predominantly European and Irish shares. We got to be looking at having the shares that are furthest market and furthest environment, because that's exactly what people will capitalize on.
Mohammed, how do you see the differing regional traders?
Well, when it comes to European clients, we have to realize they are following completely different set of rules. They are working based on a leverage of maximum 1 to 30 on measures. So these people are not necessarily involved in the market in the same, using the same strategies or the same, flavor of trading like Middle Eastern clients. Very few, for example, will go for oil, for instance, while the Middle East feel like, oh, we have a lot of oil, so we should know better about it, and they get involved. The other thing you will realize always, European clients are more long-term. They will, and of course, the leverage or whatever is offered for them help into deciding for them how they need to approach, the trade. On our side, we always try to simply, provide the clients what they need. Cryptocurrencies, whether it's European clients or clients from everywhere else in the world, like the Middle East, we are providing that on our platform, and we are continuously increasing based on safeties, simply because we are not an exchange for that, but we are catering for clients. As you mentioned, we are serving the clients, and whatever the clients will demand, they will have to always find, available on our platform, hopefully.
And Ziad, how do you see the differing trading trends between regions and what people are picking?
Yes, well, I think traders are traders all over the world. Like here in the MENA region or in the Middle East, you'll see traders that are driven by emotions, by greed and fear. You'll see also traders in Europe or even in the US that are also driven by emotions, as well as you'll see here in the Middle East, traders that, for example, rely on the proper research to take an investment decision, or other traders that would do proper risk management before like entering a trade or opening a position. And that usually is everywhere, because at the end of the day, traders are human beings and they behave the same. However, as my friend there was saying, usually the major asset classes or the major instruments attract traders globally all over the world. And because accessibility is there and people can access these markets easily when dealing with multi-asset brokers, they are able to trade these instruments. However, as he said exactly, there is the country where you live, where you're raised, the culture that you come from usually affects your decision. I give a quick example. For example, a trader in Saudi Arabia would be interested in trading, for example, local markets, and would want to benefit from the movement of the prices, let's say, in the local stock market, like buying and selling Aramco's stock. I'm here in UAE, trading Emirates MBD or trading the local stocks here do not really scare me because I'm very familiar with them. I use these services. The same thing would happen in Europe, and the same thing would happen in the US. Plus, the effect of the culture goes beyond that. Like, for example, because we come from countries that produce oil, and oil is in the news all around us and affects our economies heavily. We might see like demand on oil might be higher here, for example, more than Europe or in the US. If we go to, let's say, more towards Asia, if we go to India and Pakistan, you would see more demand, for example, on gold. So there is this cultural effect or the location effect that might affect the decision of traders, or because of the familiarity with the product. But in general, from a behavior perspective, I think traders are humans and they all behave the same way. You'll find all types everywhere.
I like the fact that you brought up the emotional side, because I know particularly with crypto and the hype machines, the fear of missing out is high. It's very emotive driven, that is for sure. GT, what's your opinion on all of that?
So we are a digital exchange wherein we have clients from across Europe, Middle East, Asia, and Africa. And over the period, what we have seen that the European traders were more inclined towards doing in Forex. But after the regulations coming in place, Switzerland was one of the first one to come with the crypto regulations, followed by Estonia and other countries. We saw more and more traders getting mature to trade into crypto derivatives. And of lately, with the vision of UAE to be the blockchain center of Middle East, we have seen lots and lots of users coming on board and trading into exotic pairings on our exchange, wherein they are doing Bitcoin to gold, crude oil to Bitcoin, wherein they are hedging their positions, and we specialize in exotic pairings. And this is what we have seen, that more and more with each and every country coming out with their global regulations on cryptocurrency, more and more traders are inclined to trade on traditional assets along with these assets. So that's where we see a growth, wherein this new asset class is getting streamlined in terms of regulation, and more volumes we have seen getting from the traditional users to come on crypto and trade cross asset. So that's where I see difference between the Europeans, which were traditionally trading on these asset classes more, but of lately I have seen Middle East and African region to coming and adapting these asset classes.
And my next question to you all is, when it comes to picking a broker to trade with, is it just looking at the assets offered, or is it trading conditions, or is it a mixture of everything involved?
I'm a trader from last 10 years. So when I was choosing a broker, after starting an exchange, what I have seen is that when I'm onboarding on any exchange, be it DIFX or any other exchange, you need to take care of, are you 24/7 supporting the users? Are the funds secured or not? And what is the exotic pairings you are giving? Because there are more than 5,000 brokers available in the market. What are the different asset classes you give to your users along with their security of the funds and the support they get on the customer centric? On DIFX, what we have taken care of that the funds which they trade with cryptocurrencies. We allow users to trade on the asset classes, and we have the strongest custodian which handles the trade. So basically that custodian is insured, all their wallets are insured. So when a user comes on board on our exchange, they know that the wallets are insured and nothing will happen to their assets, what they are holding. And the customer service is what important is. So we take care of 24/7 customer service.
Jerry, I know you were anxiously wanting to jump in on that question at the end there. Yeah, go ahead. And I guess one of the big things that came up in the last panel discussion we had was security and trust as well, were two of the major factors.
Yeah, I mean, look, I guess I'm coming from AvaTrade. I mentioned at the very start, we're one of the most regulated brokers within the industry. So automatically, that's the most important thing, for any client. But I think, very seriously, it is. It's very important whether a broker is regulated within the jurisdiction where you as a client reside, but also on a global level, because it can be simple for a new startup company to get one license somewhere, and you can piggyback a license very, very quickly and set up, and then suddenly you look legitimate. It takes a very long time to get 10 regulations, and other guys here on this team, on this panel, come with a lot of regulation behind us. You don't buy it overnight. And trust comes with a long amount of experience of treating clients well, of ensuring both clients and also your partners, affiliate network, you need to instill a trust that you're a brand that can be worked with both for your clients and for your partners. And that's something that's very, very hard to pick. For clients then after that, I think comes the likes of trading conditions, which of course, for a lot of clients is the quickest. Who's got the tightest spreads? Who's got the tightest overnight swaps? But sometimes that also is not so important, because if you have somebody, again, and I'm sorry if I'm picking on the newbies, but if you come into the market and I want to offer zero swaps and I want to offer zero spreads, you're doing it only because you're trying to capture some type of foothold in the door. And you don't see the well-recognized brands doing that. We don't have a race to the bottom. If somebody wants to go offer 0.1 euro dollar, they're not doing it because it's not a sustainable business model. It's something that they want to come in and just, yes, I'm here, and make a loud noise and do a marketing campaign about it, but they probably won't be there in 12 months time or 18 months time or 24 months time. And certainly if they are still there, they won't have that type of trading conditions. So it's kind of a very short-term thing. So I think when you're looking around as a client, you have to do your research. You have to do the background checks and everything. You can even go as far as searching regulators' reports and see who has been fined, who has done something wrong. If you're really getting into the due diligence, because that is what matters at the end of the day, because you want to know where you're, and Gita, you said at the very start, you want to know wherever you put your money, that it's going to be secure. Who are the banking partners of that broker? Are they working with recognized tier 1 banks, or are they working with some money lender, some quick, payment type of thing where your money is going in and you get it back in a credit card? So I think all of those factors are very, very important. And of course, they all have to be put together when your client ultimately makes the final decision on who they trade with.
It seems like an absolute minefield. I've got to be honest. Mohammed, what should people be looking at when they're deciding to pick a broker?
Well, okay. It's not an easy question, because there is the general factors which, look for a regulated broker, look for a broker with years in the business and what type of asset it provides, etc., etc. But on the other hand, it carries so much into it. How the client is choosing, sometimes it influenced by who's introducing the client, which kind of affiliate, sometimes which kind of ad, what kind of promise actually this client have come through. Honestly speaking, whatever kind of promise you have come through, when you reach the doors or the website of a broker, do your research. You need not just a regulated broker, you need to figure out what this broker is allowing his partners to do. Because if you are coming through those partners, you want to know what is happening out there. Most old regulated, entities have been through a lot, and we have went through all types of partners and all kinds of things. So usually we end up, being very selective about our partners, our affiliates, and so on. So always be careful how you are landing at a broker. Check the history of the broker, as you mentioned, of course. Check what kind of regulation, what kind of issues have been raised in the website of regulation regarding that broker. And of course, security of funds comes, highly recommended to check on it. But at the end of the day, you have to feel comfortable as well with the kind of service, the kind of after the signing of a deal, and how they are treating you as a client whenever you need them. That's it.
Ziad?
Well, I think regulations and the history of the company is something given. But if we put that aside, as a company celebrating its 10th anniversary, we had to change our strategy based on our clients' needs. And I'm talking from the retail client's perspective. If I put myself in the shoes of the client or in the shoes of the trader, I would need to look for three things. And this is how we built our strategy. Number one, I need to work with a broker that believes in true inclusivity. And what do I mean by that? In 2021, everyone should have a relationship with wealth. And this can be done if you have easy access to the financial markets. From one platform, you're able to access the global, the regional, and the local financial markets. Why? Because in 2021, traders are looking for the opportunity wherever that opportunity is. If I am a trader in the local markets and there's something happening in the US, I need to benefit from that. I don't need to worry, where should I open an account, or how should I access that market, and how should I place a trade? If there's something happening in the crypto market, I should be able to have that access. Same for currency, same for commodities, same for everything. And this is, and inclusivity is a cornerstone. It includes as well that that access needs to be affordable, and at the same time needs to be commission-free with also low fees wherever that is applicable. That's the first cornerstone that you need to look for. The second cornerstone that you need to look for is financial literacy and financial education. In 2021, this is a must, and that should be provided by the brokers for free. And I'm not talking about webinars and seminars only. I'm talking about advanced research where you don't pay for that advanced research that used to be in the past something costly and not accessible by the retail traders, even no matter what their net worth is, if it's low or even high. So financial literacy, financial education, financial services, research in particular needs to be accessible for traders to be able to place, inform the trades. Now, the third cornerstone and the most important thing here is technology. Technology, we're talking about advanced technology, but it must be simple, because when we're dealing with retail clients, research needs to be simple, education needs to be simple, as well as technology needs to be simple. Technology is not only limited to fast execution. That's the minimum, or that's the least a trader should worry about. Technology means the whole customer journey. We're talking about onboarding, we're talking about the KYC process, the account opening, the funding, the depositing, the withdrawing the money, and the after service that comes after that, the ease of using the apps, the ease of using the platforms. So if we want to summarize it, when we talk about inclusivity, we're talking about the easy access to the multi-asset classes, and we're talking about the affordable trading, commission-free and low fees. That's number one. When we're talking about financial literacy, we're talking about education and research. This should be free as well. And when we're talking about technology, it's not only about the fast execution, it's about the full journey. These are the three main things that I would advise retail traders to look for.
And moving on to looking at the instruments to diversify trading strategy, what are the best things to use? I mean, we can look at trading volumes, things like gold, euro to US dollar, NASDAQ recently. So what should traders be looking at, the tools to help them pick their trading strategies? Jitu?
Looking at the volatility as a trader, looking at the volatilities of different asset classes, and looking at the volatility the cryptocurrencies have shown with the consistent growth over the period of last 10 years. I think for us, that's the best asset class we look for the trading, for the users to come and trade on these CFDs, because when the markets are more volatile, that's where you make more profits. If you know that how the trend is going, and that's the asset class I feel that the user should be more inclined, because it's new. There are more regulations coming. It's getting regulated now in different countries, and in next 5 years we see that there's a massive growth which will come, and it will all these regulations will be streamlined in most of the countries, and that's the asset class to look for over next 5 years.
Dire, what do you think about trading strategies? What should people be looking at?
Yeah, I'm kind of taking on what Ziad just said earlier on. I think it comes back to education, which comes back into how prepared you are as a client to enter your trade. And we could have a whole debate just about that on itself, because when you're deciding to execute a trade, you can either do it two ways. You either just pick up your phone and you go, yeah, I'm looking at what's happening on screen, I'm just going to have a go. And it's a bit of fun, and you want to test it and you want to play with it. And if it goes well, you're excited. And if it goes bad, okay, you'll try it again. And then the other opposite way is to work very, very hard. It's not easy to make money in financial markets. It's not easy for anybody, and you can see even like the biggest hedge funds in the world, and these guys are, doing this for 15, 20, 30 years. And if they make 10% in a year, that's a good year. So when you start trading and you put in $1,000 and you make $500 in a week, that's 50% in a week. You can't do that every single week. So you have to set your expectations appropriately. Leverage is a tricky part of that, because leverage makes it look very easy, but there's big risks that come with the downside of that as well. So I think one of the most important things is prepare yourself, understand what you're willing to risk, understand what your actual goal is. When you're making a trade, before you make the trade, know what is your end goal. If I'm buying here, where am I getting out? And I have to use a stop loss. I have to do it. And I can't let it go down negative and then go, oh, I'll pull it out and it'll go a bit and it'll come back, because that's the human nature of psychology of trading, which is why 70% of people lose money. And it's the 30% of people who make money are the ones that stick hard and fast to the rules. And everybody has their own way of trading. The way I trade is going to be different to you, to whoever. So there's no one rule that fits all. And all we as brokers can do is provide you as much information, provide you as much tools, but ultimately you have to decide how you're willing to trade. Are you going to be aggressive and high risk? Are you going to be very conservative and low risk and try to build something over a long term? Or you enjoy the rush of it and you want to get in and you think you can make money and you do it very quickly. But if you do that, you got to get out and you got to take it out and spend it. Don't just leave it there and sit. Take it out, spend it, reset, and come back another day. One interesting thing we did, kind of focusing on this, is we built a product called Ava Protect. And anybody that is out there that's a client of Ava will know about it. But basically, this is a tool. It's a risk management tool. And we package it in a way that when you're opening your trade, at a click of a button, you're essentially buying insurance on the trade. And you set your own, you can still set your take profit and your stop loss. But at the click of a button, there's actually an option that goes into the back end of that trade. So if you're, for example, buying euro dollar on a spot, on the back end, you're actually selling a call to complement that trade, to protect that trade. So if your trade goes up the way you're expecting it to do, you make your profit and you're very, very happy, and you'll pay the cost for insurance, and that'll be deducted from it. If the trade goes against you, which 50%, at least 50% of the time it will, you lose your money, but the option kicks in and it refunds you your money back. So we as a broker, we're trying to push this product, especially for new people, because new people are trying to learn, and this is a great tool for, allowing you to do it in a very risk-averse way, for a small cost. Nothing comes for free, apart from education and apart from the other stuff you mentioned. But, tools like this don't come for free, but it's a real market application. And I'd encourage anybody to try it. We're trying to push this as a new product because it encourages people to make money, to really, really make money and protect their downside. And I think it's something that could be very, innovative in the future as we see other people pick up on it.
I love that there's been one of the running themes of all the sessions today has all been about education. And if I go to the WhatsApp and the Telegram groups that I'm in, the two pieces of advice everyone gives: do your own research and only invest what you can afford to lose. Those are the two big things. And hold on for dear life. So I am a little bit aware of the time. So Mohammed, I want to come to you with this one. We talk about one of the best things to do is have a diverse portfolio, diversify into lots of things. So what are the best asset classes that you would currently recommend people to focus on?
Okay. I would not say specific asset classes based on, for example, what our analyst would say, but I would say each and every single client out there should diversify, but based on his own knowledge, his own information, and the access to reports, the access to research of the different classes that he's going to be involved in. If it is going to be, for example, crypto, then by all means, have something that will keep you informed every 5 minutes. All right. Now, if we're talking about, you're going to be into Forex, then by all means, if it is going to be Euro USD, keep an eye on what's affecting the relationship between these two currencies. Everything will count. So you can diversify, you can have oil, you can have gold, you can have cryptos, you can have Forex, but can you actually keep an eye on all this at the same time? By all means, if you have nothing else to do, then good. Put this, 24/7 into following up with such portfolio. If not, then figure out exactly which ones you are comfortable with, which ones you are comfortable with their level of volatility, and how much, things can change, and what are the factors that can change the direction, and how far this could lead. Somebody who's doing crypto should expect that in any given day, within half an hour to 1 hour, things could go down 10–15%, up or down, whatever. Mr. Musk could file a tweet, and before you know it, things are going into either direction. Now, this is not going to happen, for example, if you are just trading euro, for instance. Things are not going to move the same way. That's why keep, by all means, a portfolio. Keep different assets, but based on your time, your abilities, and the access, to information, and how fast you can react to this information. But otherwise, no chance to simply just follow a suggestion from one or another. From our company, we have dedicated analysts, but that's their job, 24/7, but not yours.
I do love Elon and his market manipulation through tweets. It happens every time. Ziad, what do you reckon? What I say, so a complete newbie comes to you going, what do I invest in? What am I going to look to trade in? I'm trusting you to help me out here. And
Yes.
Yeah, so what would you recommend?
I would say the best investment and the best asset class is yourself. You, as a newbie, you need to invest in yourself. That's the main thing. And I would like to stress on that. as much as I can. I mean, let's take a simple example for all of us to understand. So if I say, for example, maybe if you go and invest in index funds or index ETFs, it might be a safe investment. But at the end of the day, it's how you treat the investment. Like, for example, if you are trading or investing using scared money that you cannot afford to lose, it's not related to the instrument itself. It's now related to you. That's a very bad decision. And any investment or any instrument, even if the prices are not volatile, becomes a really risky investment. That's number one. As my friend was saying, if you're entering a position without knowing why you're entering it, at which price you should enter, and at which two prices you should be ready to exit, whether on a take profit position or a stop loss position, you're making a big mistake, regardless of the investment, even if it's not volatile as well. Here comes the problem. Risk management as well. You need to learn the basics of risk management, because in risk management, it is how you be able to identify where to enter as well as where to exit. That's number one. Risk management, also proper risk management, teaches you how to diversify your investment. What's the percentage of your investment capital or the trading capital that you want to use? What percentage of it you would use to trade a specific instrument, and how to diversify. Risk management also will teach you, proper risk management education will teach you how to diversify among different asset classes, because even if you're allocating the proper percentage per instrument, you cannot put them all in stocks or all in crypto or all in currencies. You have to even diversify across different asset classes. So I wouldn't recommend any asset class or any instrument. I would make it simple. I would just say, first, the best investment is by investing in yourself.
Wonderful. Thank you so much. We have just about run out of time. I'm very aware of the time and that we do have other speakers to get through before the end of today. So thank you all for joining me for this panel. It's been very informative. And I'm sure if you have any questions for any of our speakers, they'll be happy to answer your questions at their booths over the rest of today and also tomorrow. So thank you very much, gentlemen. It's a pleasure.
Thank you very much.
Thank you.
Thank you.
Thank you.
So, ladies and gentlemen, without further ado, we'll get on to our next speaker at the moment. And we have Amgad Atia. He is here from FXDD, and he's going to be talking to you about the impact of COVID-related inflation on the global financial markets. So, take it away. Welcome to the stage.
Thank you. Thank you. Hello, everybody. Okay. So just to give you a quick heads up about FXDD, I don't know if who knows FXDD. So we've been in New York City. We were started in 2002 as one of the main brokerage firm and the first brokerage firm that actually opened in New York. We've been there since then. I'm based in New York. I've been with FXD for 15 years. I have my CTA license. I've got all my certificates from New York. So we've had many years in the business. We're regulated under the FCA. We're regulated under the MFSA. We're regulated under the FSC in Mauritius. So we have multiple jurisdictions that fits everybody's needs if you're interested in opening an account. So FXD is located at 7 World Trade Center in New York. This is our headquarter office. This is our building. You know, this is just some of the images. So FXD was one of the original sponsor for Formula One. We sponsored Formula One in 2010, 2011, 2012. And we've sponsored some race cars, Ferrari race cars as well. So just, you know, this is our car with our logo on it, just to give you some of the things that we have done. So, you know, I'm sure you guys all feeling the effect of inflation that we've seen, that you guys see around every day. If you're traveling and if you're going to the supermarket, you're starting to notice that things are getting more expensive. So this is something that we have had, you know, in the last couple of years, we have had, you know, huge number of inflation, especially since COVID started and since COVID, you know, since hit the financial markets. So throughout, you know, 2020, 2021, we have seen a wild ride in the FX market and the global equity market that has affected everything. Okay. So what we'd like to say is, you know, the hyperinflation that we have seen is basically an unintended consequence of the distortion created in the financial market by fiscal and monetary policies. So extended lockdown across the globe have led to depressed in demand. So when COVID hit, you know, there was no demand. Everybody stayed home. We couldn't get anything, so nobody was working, so there was no production. Once we started to see, you know, things starting to open up, we saw a huge rise in demand, and we have seen a huge strain on the supply chain. You know, this is like we went from nothing to everything. Everybody wants everything, and everybody wants it now. So the stock market, you know, in late 2020, we had some winners and some losers. So if you invested in the stock market, whether in the US or in Europe, you'll start to see some sectors that have really benefited from this. The main sector was the technology and the medical sector. You know, these were the biggest winners. If you traded Apple, if you traded Google, if you traded Amazon, you know, these stocks have doubled up literally within a year. But if you were trading in hospitality or if you're trading in other you know sectors, these were not benefited from this as much as the other. So central banks around the globe played, you know, their usual role in the crisis. So what they did is they cut interest rate and provide free money. So basically, let's cut the interest rate and you know, let's give easing, so free money basically. So when you do this, you create huge amount of inflation. So everybody wanted, you know, everybody wants to be on this. You want to go to the stock market, you want to trade, but there's no money. So what did what the central banks do? Okay, we're gonna cut interest rate. We're gonna make lending very easy and very cheap. So this has created this huge distortion in what we have seen. You know, fiscal policies, you know, provided the second leg of recovery. So we saw stimulus packages in the US. We have seen Europe, you know, now we see Biden is trying to, you know, to have a $3 trillion in terms of a, you know, fiscal package. So basically giving free money to every green energy, climate control, all this stuff. This is all creating huge amount of pressure because you only have limited number of goods that you can sell. But in the meantime, you have a huge influx of demand and you have a lot of money. So it's supply and demand. So if you have small amount of goods limited supply, but you have huge demand, it will only lead to a sharp rise in prices. And this is what we have seen across the globe now. So, we have seen a big change in the White House in the beginning of the year. We went from the Trump administration to to what we call it, the Biden administration. So this has, each one of them have a different policy. If you're looking at the Trump administration, he was pro-oil production, pro-fossil fuel. But when you look at the Biden administration, you see an entirely different policy. They will see green energy. They will see, a lot of restriction on fossil fuel. This disparity has caused a huge issue in terms of what we're dealing with on daily basis. The Biden administration, the Keystone Pipeline, this was a huge thing for energy in the US. They have put so much restrictions on, on new exploration for oil. They're trying to put a lot of incentive for green energy. This have really played a massive role in changing the dynamics in the US. So you look at oil prices in the last, 6 months, you notice a huge increase in oil prices. You notice a huge increase in natural gas prices. These increases, because there is so much demand and there is little supply, have caused this inflation. And this is what we are seeing right now. We're seeing a huge problem in Europe. If you guys are watching the news, you'll see that there's a huge issue in the UK. They can't find, there's not enough gas supply. Natural gas prices in the winter, as we come into the winter month in the US and in Europe, they're gonna see a huge jump in prices in home heating oil prices. This is all adding to a tremendous amount of pressure on the consumer, the final consumer, you, me, and everybody who's actually, consuming. So, if you're looking at the cryptocurrencies, what role did it play in the current situation that we have? When you look at the big commodities, you'll notice that gold, for example, gold is a natural hedge. Whenever there is inflation, gold prices usually go up. But we are seeing a different type of economy now. Crypto is becoming the new gold. Why? Because crypto is limited in supply, is easy transmitted or easy moved from one hand to another. There is a lot of secrecy in how the money is moved. There's not a lot of transparency. So a lot of people interested in moving or actually acquiring crypto. So we have seen a huge rise in crypto in the last maybe year or so. We went to 65,000 in Bitcoin. This is never, these prices have never been seen before. So what happened is this, people are trying to basically, hedge the inflation by purchasing crypto, hedge the inflation by purchasing gold. So that's why we've seen this huge, increase in gold prices and crypto prices, all the cryptocurrency. So people trying to find a way to keep up with the rise in inflation. So this is one of the issues that, or one of the things that you have seen. When you look at the financial market, you need to understand why these things are going up, why it's going down. You need to understand the fundamentals behind the movement. And usually there is always a reason why the market is going up, why your market is coming, is coming down. So it's one of the things that you always keep in mind when you're trading, when you're opening position, when you're closing position, you're looking at the fundamental, because I know that some people would only like to look at the technical. Because the technical and the fundamental, they move hand in hand. They are moving together. And a lot of time, the news is the one that moves the technical side. So you always have to keep an eye on, on the situation. So, throughout the last year, the central bank led by the Federal Reserve have maintained inflation is transitory. So anybody who watches the ECB or watches the Federal Reserve, you will hear that word, quite often. The inflation is transitory, and they expect the inflation, to subside in 2022 when supply and demand basically balance each other. I honestly don't think so. I think, the way the central banks are going by making borrowing very easy, by making the cost very cheap, will fuel the increase in demand. And the supply chains at the moment simply cannot catch up with what is happening. We have seen issues with the, with the very different variants of Corona, Delta and another variant that is spreading in China, spreading in the US, spreading in Europe. There are threat of lockdowns in other places. So there is still a huge, restriction that is placed on the supply chain. And this will not really ease the pressure that we've seen. In the US, they're starting to, certain supermarkets starting to ration things again. You cannot buy more than one of certain things. In Europe is the same way. So the fact that the Federal Reserve and other central bank keep saying this transitory, it's not really, we do not see any evidence in real economy that inflation is transitory. I think inflation is here to stay. We might see a less than, less sharp decline than what we're seeing now. But I think eventually the rate of inflation will remain at 4 and 5% versus the usual 1.5 to 2% that we have been seeing in the last several years. So whenever you're trading, whenever you're especially in terms of commodities, cryptos, gold, you really have to keep an eye on the news releases, and you have to keep an eye on inflation gauges, because these things will affect things dramatically. If you're following the stock market, for example, yesterday was a brutal day on Wall Street. Why? Because they think that inflation will dampen demand, will affect demand. The rise in inflation is keeping less money with people to buy. So it's affecting the global economy. And they also believe that eventually the Federal Reserve would have to raise interest rates much faster than they anticipate. They anticipate they're going to start raise, interest rates within, by the middle to end of 2022. I think the Federal Reserve would have to move early 2022. They have to stop the easing. They have to try to normalize the market, because there is no way that things will continue to in the trajectory that they are in at the moment. So currency, on the other hand, if you're trading currencies, you would notice that 2021 is a lot different than 2020. If you're trading currency, we've seen really wild ride in currencies. But if you're looking at 2021, you'll see that everything have been kept in a very short or very small range. So you're really not seeing this big swing. So if you're looking at euro dollar, if you're looking at pound dollar, dollar yen, you'll notice that the trading has been done in a very short, small range. Why? Because everybody in the same boat. You're not going to see the same swing that you've seen in gold or cryptocurrency. There's simply no way that you'll see this in currencies. Why? Because everybody, all the major central banks have almost zero interest rates. Some have even negative. All the central banks are easing, and nobody dare to talk about raising their interest rate, because they know that this will increase the value of their currency, and then this will affect their export. Because remember, major economies, US, Europe, Asia, they're always interested in keeping their currency rate low. Why? So they can help with exporting, exporting more and making their price competitive. This is why China, for example, artificially keep their exchange rate to the dollar very low. Why? To be a little bit more competitive. So you're never going to see the huge, rise in prices or rise in difference between the different currency. I would say until 2022, sometime in 2022, when you start to see central bank talk about raising rates and actually doing it. And I think the Federal Reserve in the US would probably be the first central bank to actually start raising rates. Why? Because the US economy seemed to be recovering faster than a lot of other economies. And I think the Federal Reserve has always take the lead role in raising interest rate. And also, when you have a Democrat administration in the White House, they always prefer to raise interest rate, and versus a Republican, administration that always like to keep interest rate at a low. So this is just some of the charts. I know we have limited time, so I don't want to take a lot of your time. So I just want to, just end my presentation here. And I just want to see if any of you guys have any question that you would like to ask. I'll be more than happy to answer any question. Okay, so I would like to thank you for listening. I appreciate you all being here. If you have any questions, please stop by at our booth at FXD booth 69. I'd be more than happy to answer any of your questions. We have special offers. If you guys would like to trade with us, we'd be more than happy, and we'll provide you with a couple of promotional offers that we have. Thank you, and I appreciate you listening.
Thank you so much, Sir Amgad, for that wonderful insight there. And we're going to go straight into our next session, and that is how to trade the NFP on October the 8th. I had to ask because I didn't know, but a man that knows all about it is Giles Coughlin. He is head of brokerage at HYCM. Welcome up, Giles. Where are you? He's coming from over there. It's a long walk from the back of the hall. I feel like we need to play some kind of Oscar stage welcoming music to everybody coming up. It'd be so nice.
Well, a very good afternoon. It's very nice to be here with you. I'm looking forward to detailing how to trade the non-farm payroll next Friday. I'm going to be sharing with us some actionable analysis that can help us understand what instruments are likely to do depending on what happens next Friday. Before I start, if you're feeling a little bit sleepy, and you'd like to stand up and shake your legs, please feel free to do that because I know you've had a long time sitting down. If you don't want to do that, that's absolutely fine. But if you just want to have a little stretch, shake your legs around, feel free to do that. Well, without further ado, I'm going to get into our presentation. I am one of the key analysts that works for HYCM as their chief currency analyst. And HYCM has a wealth of experience. It's a broker with over 40 years worth of experience. Now, we started in Hong Kong, but since then, we've spread with offices all over the world, in London. Here we have an office in Dubai, Kuwait, Hong Kong, and Limassol. So we have a broad, global, and a deep, rich heritage that's based on being financial experience that you can trust. We have significant regulation from some of the most strict regulators in the world, including the United Kingdom's Financial Conduct Authority, the FCA. You can just see there. We also have the Dubai Financial Services Authority, as well as the Cyprus Security and Exchange Commission and the Cayman Islands Monetary Authority regulation. So we have a broad range of regulation from around the globe reflecting our global presence as a broker. We also have picked up a number of awards over the years, including Best Forex Broker from World Finance in 2021 and Global Finance and Banking Best Forex Broker 2020. We're also featured in numerous top media publications. I appear across many different media publications, making complicated financial concepts simple. That's one of the key things that I offer as my chief currency analyst role, is to explain sometimes complicated financial concepts simply. And as a result, I am regularly featured across some of the world's top media. As a broker, we allow our clients to trade FX, commodities, the major world indices, as well as individual stocks. We also have an MT4 and MT5 platform and a proprietary mobile trading app. One of the good features of HYCM is you can deposit and withdraw your deposits in dirhams here in Dubai. And you can also make those deposits at local banks. So it's a very convenient way of transferring money locally here in Dubai, which I thought was worth mentioning since we are here in Dubai. We also offer free access to professional trading tools. One of my passions, having come from the retail trading background, was how few professional tools are actually available to retail traders. That's one of the things that I've brought to HYCM's clients, and I'm engaged every single day explaining complicated market concepts to our retail clients. We also have online and offline trading education, including one-to-one consultation with myself as part of some trading packages that we have. Myself, it's always a bit embarrassing to introduce yourself, but I've got over 10 years experience in technical and fundamental analysis. I've already explained how I appear over the world's media, making complicated financial concepts simple. I also am a regular contributor to Forex Live. I have a daily blog there. I don't know if does anyone here follow forexlive.com? Well, I'm a daily contributor there. It's a very good website. If you haven't yet found it, you definitely want to find forexlive.com. And I'm one of the senior analysts at Financial Source. So I won't talk about myself anymore. Let's get into the details. How to trade the non-farm payroll next Friday. I'm going to explain to you now why the non-farm payroll is important and why it's particularly important next Friday, and how certain instruments are likely to react. So it's going to be three things: why the NFP is important, why it's particularly important now, and of great interest to traders is how we'd expect certain instruments to use and how to trade it. So what exactly is the non-farm payrolls report? Well, the non-farm payrolls report is arguably one of the most influential economic releases in the economic calendar. It gives a picture of what US employment is like. Now, the US is the world's largest contributor to GDP. About 25% of all the world's GDP comes from the US. Now, when you look at the US economy, 2/3 of the US economy comes from the wages and the salaries of the US citizens. So what the employment is like in the US is a very big indicator for not only the state of the US economy, but also the state of the economy across the world. The other reason the non-farm payroll is very important is due to the timing of the release. It's usually released on the first Friday of the month following the data it represents. So for example, September's jobs are going to be released on the first Friday of October, hence October the 8th. So those reasons mean that US employment is always important, and it's very important not only economically, but also politically. Now, the breakdown of the separate components are as follows. You have the headline reading, you have the participation rate, and you have the unemployment rate. Now, the jobs number is consisting of two major surveys. The first survey is a household survey, and that is a survey done by the US government of US householders. A total of 60,000 US householders are interviewed by the US government. It also consists of a payroll survey, which is 444,000 companies which are interviewed, and the companies themselves send the data in for the calculation. Now, the headline is the big figure, and that just tells you how many jobs are added, how many jobs are lost. And that's of particular importance coming up now, and I'm going to explain that why in a few moments. But I thought it was also helpful just to understand how it worked. You can see here the participation rate. Now, the participation rate is simply everyone who's over the age of 16 who is either in work or able to work. Now, when an economy is doing well, the participation rate rises. When an economy is doing badly, the participation rate falls. In the US, the participation rate has been rising since the 1960s with the entry of women into the labor force. The unemployment rate is simply the number of people who are unemployed. And that data for the unemployment data is taken from the household survey. Now, there's many more little details I could get into with you about the non-farm payrolls. But I wanted to not only give you a very brief introduction what it is, why it's important, but as traders, we want to know what's important right now, because that's where the opportunities are. And the focus right now is obviously on the US interest rate projection. Now, on September the 22nd, Jerome Powell gave a little surprise to the markets, saying that he expected bond tapering from the US to be completed by the middle of next year. Now, he also said that sufficient progress had been met with inflation, and he said it's all but met with employment. So he said he didn't need to see one really good jobs report. All that's needed is one solid jobs report, and then that confirms what the market's been pricing in over the last 4 or 5 days, namely a November taper announcement and tapering to completed by the middle of next year. So this means the first test of the Fed's outlook is coming with the jobs report due on October the 8th. So mark my words, traders will be looking at this very carefully. Why? Because it either confirms the Fed's policy or it contradicts the Fed's policy. Do you remember the dot plot shift at the last rate statement? Remember how Powell announced surprise tapering to finish by the middle of next year? There was a little shift that went on, and I was speaking on my Twitter account, who was following me at Giles Cochran CCCA, about the symmetrical triangle pattern in the dollar-yen. That's broken out very nicely, approaching 111. And if everything stays on track, I'm expecting that to move to 115 over the next few days and weeks. So all that's needed is this one good, decent jobs report. Now, remember I showed you the different components of the NFP? Well, that's important because when it comes to detail, what ideally we would want to see is the jobs, the participation rate, and the unemployment rate all pointing the same way. So if the headline was good, if the participation rate was high, if the unemployment was low, that would mean a very hawkish outlook that we would expect. And as traders, that's what we're looking for. We're looking for the clearest, the most obvious, the most succinct analysis in order to explain and understand what's happening. So as I said, Jerome Powell, he said, look, this was the key phrase, employment test is all but met. We're basically there, he's saying. So this is the number of jobs in the US. You can see here that large paled out bar chart. That was the number of jobs before COVID-19. You can see here the gradual recovery. The closer we get to that peak, the more reassured the Federal Reserve is going to be. Now, there are wider questions about the state of the US job market. Have some people taken early retirement? Were some of those people signing on just for bonuses, like an Apple and Amazon, then they're going to withdraw from the labor force? However, the headline figure that the Fed want to see is another strong jobs report. And the first test is going to be October the 8th. So how will this impact the US dollar? Well, the US dollar yen looks set for significant gains. When I was preparing this seminar, the US dollar Japanese yen was in a nice symmetrical triangle breakout, and I've got a 300-point target. Now, the US dollar 10-year yields and the US dollar Japanese yen, they tend to track each other. So that breakout in US 10-year yields, a simple way of trading that, if you're not trading bonds, is to trade the US dollar Japanese yen pair. It's a trade I'm looking at and will stay with as long as the conditions look appropriate for 10-year yields to rise going forward. You can see here, this is the US 10-year yields. Now, when the yields are rising, it's because bond traders are expecting coming interest rate hikes. So with the Fed signaling that they're moving towards interest rate hikes, it's only logical that bond yields start moving higher. So as the bond yields are moving higher, we're expecting the US dollar Japanese yen pair, the 10-year bond yield, if you overlay the charts, you'll see there's a very close correlation. They don't always correlate, but they do for the majority of the time. And when they're not correlating, there's usually a clear reason. So one of the interesting things, I was speaking to a number of people, is how will this impact gold? Now, if you're trading gold, these are the three charts that you have to have. One is real yields, which I'm using in the blue line. I'm using that as a proxy for real yields. Then the dollar index is the red line and gold is the yellow line. If you look here, September of 2020, that's when gold really rose high. Do you remember when gold really rose high? Well, people who understand the way different markets correlate were not surprised by that. Why? Because real yields were moving lower at the same time the dollar was moving lower. Do you remember how at the end of 2020, everyone was very bearish the US dollar? Do you remember that? Well, real yields were also falling as well. Now, real yields is the US 10-year bond subtracting from that inflation expectations. That's what the real yield is. And it's the most sensitive, gold is the most sensitive to movements in real yields. So when real yields and the dollar fall together, that was the perfect environment for gold upside. Now we have the exact opposite. Real yields are rising again. Why? Because bond traders are expecting interest rates to rise. And the dollar's rising. That's why gold has been falling over the last few days. That's why, despite there being one of the best technical weekly bullish pin bars on the gold chart, I wasn't wanting to buy gold because I knew the fundamentals were completely wrong for buying gold because real yields are rising, the dollar's rising, so that means gold should be falling, and that's the pressure. Now, the good news is that on Friday, the 8th, there's going to be a reassessment. That's what the markets do. They expect one thing, then incoming data comes and they reassess. And the opportunity and what I teach people learning to trade is how to trade this, the shift. Okay? It's the shift. And the way to understand it is imagine like this. Imagine I said to you, you're coming to my house and we're going to go out for a lovely meal in a top restaurant. And every time you call me, I say, you're coming to my house, we're going to a top meal in a great restaurant, make sure you look really smart. And then one day I say to you, actually, we're going to go to McDonald's. How will you feel? Disappointed. You feel upset. You think, oh, this guy had my hopes up. Do you see? There was a shift. And that's exactly the same way that people trade the financial markets. They expect. Oh, there's a shift. That's what can potentially happen on Friday, the 8th. So this is the way that we can typically expect markets to react. If there is a hawkish outcome for non-farm payroll, so if the jobs exceed maximum expectations, then we'd expect 10-year yields to rise, the dollar to rise, dollar yen, gold to fall, and stocks to fall as well. Now, the reason stocks fall is because if interest rates are rising, it will become more expensive for companies to service their debt. So future profitability is hit, stocks fall. And we have exactly the opposite for the dovish outcomes for NFP. Now I have to wrap things up. I've been given some signals to close. I have a lot more to say, and you can follow me there at Twitter and also my blog, and follow me here at LinkedIn if you want to take those details quickly. And I'll just explain some other opportunities that we have as well. Now, if you would like to trade into the year end, I am going to be sharing at the Duke's Hotel in Dubai on October the 1st from 4 p.m. to 8 p.m. how to trade into the year end. I'm also going to share with you the professional tools that professional traders use to trade. I'll show you what they are, I'll show you how to use them, and I will give you access to professional analysis, including access with myself on a day-to-day basis for an ongoing period of time. I know how hard it is to learn to trade because I learned how to do it. I also know how to teach others, and I enjoy it because I get satisfaction from opening the Pandora's box and making the complex plain. That's what I love to do. That's what I'm here to do. And if you want to find out more, please do. You can also come and meet us at booth number 22, just outside the door on the left, HYCM. We have a number of different packages and it will be really great. I also have some leaflets to hand out at the booth so you can register if you'd like to find out more. Thank you all very much for your time. It's been a pleasure to be here. Thank you. Thank you very much.
Thank you so much, Giles, for those wonderful insights, and do make sure you head to his booth and check him out and book your seat at that session as well. Up next, we have a keynote speech on market and trader psychology. We'd like to welcome up Thawat Gad, Chief Currency Analyst at Silwana Brokerage. If you'd like to come up, thank you. Come on, guys, let's get some energy here. We're in there. We still got a little way to go yet. You've kept your energy up. It's good. There you go. Yes, you can use that. Oh, they didn't give you a lapel. So backwards, and that's a laser pointer. Is this forward? That's forward. Yeah.
Good evening, everyone. I am very happy to be with you in the hall. But I will ask you to allow me speak in Arabic, but presentation will be on screen by English. The topic today for crowd psychology and technical analysis. أهلا وسهلا بحضراتكم جميعا. أنا ثروت جاد، محلل فني في شركة سلوانا للوساطة. حابب أعطيكم نبذة عن شركة سلوانا. شركة سلوانا للوساطة هي إحدى مجموعة شركات سلوانا القابضة، والتي تم تأسيسها عام 2011 بجمهورية مصر العربية على يد الدكتور فراس محمد أبو هديب وسمو الشيخ ناصر بن سلطان القاسمي. مجموعة شركات سلوانا القابضة تمتلك عدة من الشركات، منها شركة سلوانا لتكنولوجيا المعلومات، شركة سلوانا للتعمير والإنشاء، شركة سلوانا للاستثمار الغذائي والأمن الغذائي، وشركة سلوانا لخدمات النفط والبترول، وحاليا شركة سلوانا للوساطة في البورصات العالمية. أول نقطة نحب نتكلم فيها بعض المفاهيم العامة عن التحليل الفني في الأسواق المالية. التحليل الفني في الأسواق المالية بيعتمد أولاً وأخيراً على سيكولوجية الجمهور، بمعنى إن السوق دايماً زي ما هو بيتحرك بناء على تحليلات أو اعتمادات فنية أو إخبارية، أيضاً بيعتمد على سيكولوجية كل فرد من الأفراد داخل السوق. يعني بمعنى أصح إن إحنا كأفراد إحنا اللي بنحرك الأسواق. تمام. ومن هنا نقدر نقول إن سيكولوجية الجمهور هي الدراسة الواسعة لكيفية تأثر السلوك الفردي عندما تتجمع حشود كبيرة من الناس. الأمر الذي يؤدي بنا إلى عقل الحشد أو عقل الجمهور. وعقل الجمهور المقصود به إن لما يكون كل شخص موجود في وسط جماعة من الأشخاص بيغلب عليه نمط أو تفكير الجماعة وليس تفكير الفرد. ده بيؤدي لشيء آخر بيسمى بنظرية القطيع. ونظرية القطيع فيما معناها إن هي نظرية الجماعة، أو نظرية الجماعة هي اللي بتؤدي إلى القيادة وليس كل فرد بمفرده. نهاية، حتى نصل لمفهوم ثابت للتحليل الفني، لابد أن نقول أن التحليل الفني هو دراسة لسيكولوجية الأفراد، هو دراسة لسيكولوجية الجمهور. هو ده التحليل الفني. حتى لو في التحليل الفني اعتمادات على الاتجاهات أو كل شيء، بيعتمد في الأول والآخر على السيكولوجية. النقطة الثانية، في 3 قواعد لحماية كل فرد موجود داخل السوق. أول قاعدة في التحليل الفني، القاعدة دي بتقول التواضع، أو خلونا نقول زي ما هي بالترتيب زي ما ظاهر قدام حضراتكم، الديسيبلين، أو اللي هو ضبط النفس والانضباط. بمعنى إن ضبط النفس في سوق الفوركس خاصة، وبنقول خاصة لأن أحجام التداول في سوق الفوركس كبيرة جدا والسيولة بتاعته عالية، فبيكون حجم المخاطر فيه أيضا عالية. فضبط النفس في سوق الفوركس هو القاعدة الأولى، يعني الانضباط واتباع قواعد نظام التداول الخاص بك أنت كمتداول وليس بالجماعة، أمر مهم جدا للغاية. ومعظم أو أغلب المتداولين فشلوا في اتباع قواعد نظام التداول الخاص بهم ويخسرون أموالهم في السوق. ليه هو بيخسر فلوسه في السوق؟ لأنه هو بيفشل في اتباع نظام معين هو وضعه لنفسه. النقطة الثانية في القواعد الحماية هي الصبر. بمعنى أن الصبر في التداول مهم جدا. الصبر والتوقيت في كل شيء. التجار الفائزون يصبرون. التجار الفائزون يصبرون لأنهم يعرفون كيف يتحكمون في دوافعهم حتى يتصرفوا بشكل حاسم في الوقت المناسب، بدلاً من التصرف بشكل عشوائي أو التصرف في وقت غير مناسب. ويتم التصرف بناء على استراتيجية للدخول والخروج في السوق. يعني بمعنى أدق، كل شخص فينا وكل متداول بيحط لنفسه استراتيجية. الاستراتيجية بتاعتي بدخل بيها السوق، بكون عارف امتى انا هخرج فيها من السوق. النقطة الثالثة، ودي نقطة مهمة جدا، هو طبعا كل النقط مهمة، هم 3 نقط، وال3 نقط بيسموا بحماية المتداول، فلازم طبعا يكونوا ال3 نقط دول مهمين. النقطة الثالثة هي التواضع. لما نيجي نسأل أي شخص موجود معانا في القاعة أو أي شخص من الخارج ونقول له إيه هي أهم الصفات اللي المفروض تكون موجودة في أي متداول ناجح، ممكن يقول لك الاتزان، الصبر، ممكن يعطيك أي صفة، مفيش مشكلة، بس مفيش حد ممكن يجي يقول لك التواضع. قاعدة مهمة جدا بتقول إن التواضع هو أهم شيء، لأن المتداول المتواضع لما صفقته بتبدأ تخسر بيكون عارف إزاي إن هو يتقبل الخسارة بتاعته، ويكون عنده خطة بديلة إن هو يعوض الخسارة لمكسب. بمعنى أصح لا يتكبر على السوق، هو إنسان متواضع عارف إن هو دخل السوق الصفقة بتاعته خسرانة، بالتالي إن هو بيبحث في حلول بديلة إزاي يعوض الصفقة دي. فإحنا كده قلنا أهم 3 نقط مهمين لحماية كل متداول: الصبر، التواضع، ضبط النفس. في قاعدة مهمة جدا بتقول إن تقليل الخسائر هو السبب الرئيسي لتحقيق الأرباح. يعني أنا لما أدخل السوق عشان أتداول يكون هدفي الأول الطبيعي هو الربح، مفيش مشكلة، بس لازم يكون هدفي الأساسي هو تقليل الخسائر ومن ثم تكوين الأرباح. دي قاعدة مهمة جدا، أي متداول بيمشي عليها بتكون أموره أفضل. ندخل على المرحلة الثانية. يعني احنا كنا بنتكلم الأول في السيكولوجي وسيكولوجية الجمهور، وازاي سيكولوجية الجمهور بتأثر على أداء السوق وحركة السوق، وازاي السوق بشكل عكسي بيأثر على الجمهور. التحليل الفني تعريفه هو دراسة سيكولوجية الأسواق، وأيضا الكثير من المحللين بيقولوا إن الرسم البياني بيوضح كل شيء. فبالتالي عشان نعمل عملية دمج للتعريفين دول، يبقى لازم نقول إن التحليل الفني هو دراسة علم نفس الجمهور. يبقى احنا جمعنا سيكولوجية السوق وسيكولوجية الشرط أو الرسم البياني اللي بيوضح سيكولوجية المتداولين. في تشبيه بيقول إن المحلل الفني بيشبه تماما الطبيب النفسي، بمعنى إن الطبيب النفسي بيحاول يفهم مرض الشخص اللي قدامه، كذلك المحلل الفني بيحاول يفهم مبدئيا أول شيء عنده نفسية المشاركين في السوق، فبالتالي يقدر يفهم سيكولوجية الجمهور كله ويقدر يحدد الاتجاه العام للسوق. في بعض المتداولين بيميلوا لاستخدام التحليل الفني، وفي البعض الآخر لا يقتنع بنسبة 100% بالتحليل الفني وبيفضل انه يشتغل على التحليل الإخباري أو التحليل الأساسي. طيب احنا كمتداولين لازم نكون عارفين الفرق ما بين التحليل الفني والتحليل الأساسي. أول حاجة، التحليل الفني بيدرس التأثير على حركة السوق. التحليل الفني بيدرس التأثير على حركة السوق، بينما التحليل الأساسي بيدرس سبب حركة السوق. يعني التحليل الفني بيدرس التأثير، لكن التحليل الأساسي بيدرس السبب. ثانياً، التحليل الفني الوقت عامل مهم جدا فيه، لكن التحليل الأساسي العكس، الوقت غير مهم فيه. ثالث نقطة أو ثالث فرق، التحليل الفني تقدر تطبقه على مدى زمني متعدد، يعني تقدر تشتغل عليه على مدى قصير الأجل ومدى طويل الأجل، بينما التحليل الأساسي بيشتغل أو يعتمد على مدى طويل الأجل فقط. وده كان أكتر 3 فروق واضحة ما بين التحليل الفني والتحليل الأساسي. بعض الانتقادات الموجهة للتحليل الفني واللي بتجعل من كثير من المتداولين لا يميلوا للعمل به، هناك انتقادات من المتداولين نفسهم من داخل الأسواق بتقول إن السوق لا يتحرك بشكل فني. السوق لا يتحرك بشكل فني، يعني السوق بيتحرك بشكل عشوائي. النقطة الثانية أو الانتقاد الثاني بيقول إن التحليل الفني لا يطبق على كل دول العالم. يعني التحليل الفني ممكن يتطبق في بلد ولا يطبق في بلد أخرى. ده كان أكتر أو الانتقادين الموجهين للتحليل الفني من خلال دراسة السوق أو من خلال المتداولين. طيب بالنسبة للعالم جون ميرفي كان عنده انتقادات للتحليل الفني. أول انتقاد، جون ميرفي قال إن التحليل الفني غير موضوعي، يعني ممكن يكون علم وممكن يكون غير علم أو غير واقعي. تاني انتقاد قال إن لا يمكن للتاريخ أو للبيانات التاريخية التنبؤ بالمستقبل، علما بأن من أساسيات التحليل الفني أن التاريخ يعيد نفسه. لذلك ظهرت لنا نظرية داو، ولما بنيجي نتكلم عن الداو أو داو بنعرف أن ده الأب الروحي للتحليل الفني في الأسواق المالية كلها. طبعا حضراتكم عارفين من هو تشارلز داو، وعارفين ان هو كان مؤسس شركة عام 1882 هو وشريكه، وهم اول اشخاص ابتكروا مؤشر لقياس مدى الاسهم بتاعتهم او مدى فعالية شركاتهم. تاني شيء، كان ليهم عدة قواعد وعدة مبادئ أساسية. أول حاجة، عفواً، أول حاجة في نظرية داو قال إن المتوسطات بتحسم كل شيء، يعني متوسطات السوق هي اللي بتحرك السوق. تاني حاجة قال إن السوق عبارة عن 3 اتجاهات رئيسية، اتجاه صاعد، اتجاه هابط، اتجاه عرضي، مفيش اتجاهات تاني غير كده. تالت حاجة قال لابد أن مؤشرات السوق تؤكد بعضها البعض، أي بمعنى لا يوجد اتجاهين مضادين، يعني لا يوجد اتجاهين عامين متضادين، لابد أن المتوسطات تؤكد بعضها. الرابع قال إن الحجم لابد أن يتماشى مع الاتجاه، يتزايد في حالة الصعود ويقل في حالة الهبوط. أما لما جاء يتكلم عن الاتجاه الصاعد فقال إن في مراحل للاتجاه الصاعد. مراحل الاتجاه الصاعد أول حاجة هي مرحلة التجميع، ومرحلة التجميع أو مرحلة التراكم، المرحلة دي بتكون فتراتها طويلة جدا، يعني بتستمر من سنة ل3 سنوات، تستمر من سنة ل3 سنوات. تاني حاجة إن مرحلة الصعود فيها بيكون بطيء، ومرحلة الشراء فيها بيكون بطيء. ثالث حاجة الأخبار فيها بتكون سيئة للغاية، بمعنى إن بيسودها حالة تشاؤم. خامس حاجة جميع المتداولين في حالة يأس بسبب ضعف الاقتصاد، ما هو فيش شراء يبقى في حالة يأس. الناس كلها تنتظر أو كل المتداولين بينتظروا أي فرصة ارتفاع في السعر حتى إن هم يبيعوا الأسهم بتاعهم. طبعا أحجام التداول بتكون في مرحلة التجميع جافة أو ضعيفة جدا تكاد تصل الزيرو. بعد كده المرحلة اللي بتيجي اللي هي مرحلة المارك اب أو مرحلة الصعود القوي. مرحلة الصعود القوي هي المرحلة الثانية في الاتجاه الصاعد. والمرحلة دي المشاركة فيها بتكون عامة، وبيزداد قوة الشراء فيها زي ما شايفين دلوقتي. بعد مرحلة التجميع مرحلة التراكم بنلاقي مرحلة الصعود تبدأ تظهر، بيزيد فيها أحجام السيولة، الأخبار السارة بتبدأ تظهر، بيحصل حالة من التفاؤل عند المستثمرين والمتداولين، الاقتصاد يبدأ ينتعش فيتم عملية شراء قوي. وفي الحالة دي جميع المتداولين ربحانين. جميع المتداولين في مرحلة الصعود أو مرحلة الماركب فيز بتكون ربحانين. بعد كده نيجي للمرحلة الثالثة، ودي نهاية وقمة الرسم البياني ونهاية الاتجاه الصاعد، هي مرحلة التصفية أو مرحلة التوزيع. دي ثالث مرحلة في الاتجاه الصاعد، وفي نفس الوقت هي أول مرحلة في الاتجاه الهابط. ولما نيجي نتكلم عن مرحلة التصفية أو مرحلة التوزيع، هنقول إن المرحلة دي ما بتاخدش وقت، الفترة بتاعتها قصيرة جدا. يعني عملية الهبوط ممكن تتم في حد أقصى 4 أو 5 أيام، تكاد تكون 3 أيام، تكاد تكون يوم واحد، سريعة جدا. فيها تفاؤل شديد، فيها تفاؤل شديد، كل شيء يبدو مثالي وجيد. الجميع بيسأل امتى يتم الشراء وايه اللي ممكن نشتريه. كل الصحف ممكن تكتب عن الأسهم، فبيحصل حالة فزع عند المتداولين. دي مرحلة الديستريبيوشن أو مرحلة التصفية. بعد كده بيبدأ الاتجاه الهابط بنفس المرحلة اللي انتهينا عندها، اللي هي مرحلة التوزيع أو مرحلة التصفية. دي مرحلة التجميع أو التراكم اللي اتكلمنا عليها من شوية. الخصائص بتاعتها زي ما اتكلمنا، قلنا إن هي بتاخد وقت طويل، أخبار سيئة، الأسعار بتتحرك في نطاق ضيق، هناك شوية تشاؤم، مفيش تفاؤل، الاقتصاد ضعيف، أخبار سيئة، كل المتداولين متشائمين. نسبة ارتفاع الأسواق تكاد تكون 0%. معظم المتداولين أو أغلبية المتداولين يبحثوا عن ازدياد في السعر لعملية البيع. كل المستثمرين خسرانين. طبعا هنا حجم السيولة بيكون جاف. بعد كده بتبدأ تظهر لنا تغيير في الأيدي ما بين المشترين للبياعين أو ما بين البياعين للمشترين، تزداد القوة الشرائية، بعد ما يزداد التفاؤل، تزداد الأحجام، الأخبار الاقتصادية جيدة، إشارات شراء قوية. في المرحلة دي التحليل الفني والتحليل الأساسي بيتماشوا مع بعض. دي المرحلة الأخيرة اللي هي مرحلة التصفية ومرحلة التوزيع، ودي المرحلة الأولى في الاتجاه الهابط زي ما شرحناها دلوقتي. تيجي المرحلة الثانية أيضا الماركب، المرحلة الثانية في الاتجاه الهابط. الخصائص بتاع بيكون فيها شوية المستثمرين بيفقدوا الأمل فيها بعد مرحلة الذعر اللي تمت في المرحلة النهائية، فلذلك بنبدأ نصل لحالة ذعر تام عند المتداولين. طبعا أنا حبيت أتكلم عن سيكولوجية الجمهور، لأن بالنسبة لأي متداول اي حد فينا بيتداول لازم يعرف تحديد الاتجاه. بيهمه كتير ان هو يحدد سيكولوجية الاسواق، يهمه كتير ان هو يبقى عارف شوية عن التحليل الفني والتحليل الاساسي. انا كنت سعيد جدا مع حضراتكم. احنا شركة سلوانة للوساطة، جناح رقم 76 77، موجودين خلال المعرض ان شاء الله لتلقي استفساراتكم او اي اسئلة. شرفونا باذن الله. شكرا لكم، وبشكر شركة سلوانة للوساطة ان هي اتاحت لي الفرصة ان انا اكون موجود معاكم النهارده. شكرا.
Thank you so much for that lovely presentation. Very enjoyable for all, very informative and insightful. So, ladies and gentlemen, we were supposed to have another speaker come on, but that has now been moved to tomorrow. So that brings us to the close of day one of the Forex Expo Dubai 2021. I hope you've all found today's sessions insightful and had a good chance to talk to our speakers as well. Thank you so much, and we will see you back here again tomorrow. Thank you for coming.
इस वजह से इसको ये लगाना है, इसके लिए बना। ये आपके हार्ड डिस्क आपके पास आ जाते हैं। ये मैंने एयरटेल ले लिया था, चलो ये तो है।
ले लिया, ये वाला इतना काम नहीं किया।
हाँ, तो इसका हाथ में दिख रहेगा। मैंने बोला था ऑडियंस के भी लेंगे, तो मैंने कहा ऑडियंस के ऐसे लेने में इजी लगा। ऑडियंस को कौन सा जगह लगा देगा, जाएगा सवाल करेंगे, हाँ भी पता है कैसा लगा, कैसा फील हो रहा है।
हाँ मुझे अच्छा आखिरी 2 इंटरव्यूज में
इसको ये लगा रहा है।
मैं भी थोड़ा बहुत डिस्टर्ब हुआ, मगर उनको भी ऊंचा बुलवाया।
ये आपके हार्ड डिस्क आपके पास आ जाते हैं। ये आपकी बात ये मैंने एयरटेल ले लिया था, चलो ये तो है।
ले लिया, ये वाला इतना काम नहीं किया।
वो सुनता है इसका हाथ में दिख रहेगा। मैंने बोला था ऑडियंस के भी लेंगे, ऑडियंस के ऐसे लेने में लगा बहुत जाएगा सवाल करेंगे, कैसा लगा।
हाँ मुझे अच्छा आखिरी 2 इंटरव्यूज तो इससे पहले कुछ ये करवा दिया था,
अभी उनका के देख रहे थे। ये आपके हार्ड डिस्क आपके पास आ जाते हैं। आपको तो बार-बार मिल रहे थे, वो मुझे मिल नहीं रहा। मैंने एयरटेल ले लिया था, चलो मैंने तो बोला था ऑडियंस के भी लेंगे, ऑडियंस के ऐसे लेते हैं। कैमरा में सही करवा दो, कैमरा मुझे
आखिरी 2 इंटरव्यूज
ये आपके हार्ड डिस्क आपके पास आ जाते हैं। मैंने तो बोला था ऑडियंस के भी लेंगे, ऑडियंस के ऐसे लेते हैं। नहीं तो चाहिए मैं कल अपना